Hello, ladies and gentlemen. Can I request you all to have your seats, please? We're going to start in another minute. So good evening, ladies and gentlemen, and welcome to RISE. As you all know, RISE is an open innovation platform created by Barclays for collaboration within the FinTech ecosystem. We would like to thank LTP for getting so many new faces here. We're always happy to find new faces coming to RISE. Today, this evening, we'll have a keynote speech right from UK. Mr. Brian Lee was actually very keen to attend this event. So he said I should connect with the FinTech ecosystem in Bombay through Skype. So we've got Mr. Brian Lee from the investment banking of Barclays. He'll be giving the keynote speech, introducing the evening and the topic. So can I have a round of applause for Mr. Brian Lee?
Okay, so thank you for the invitation to speak. So my name's Lee Brain. Is it ready? Can you hear me fine? Sure. Okay, thank you. Yeah, so my name's Lee Brain. I work in the investment bank's CTO office in Barclays here in London. And what I'm going to do today is give a 15-minute overview of some of the activities that Barclays Investment Bank is performing in the blockchain space. Now, this is very much a case where it isn't Barclays itself performing and building the technology, but engaging with third parties, particularly startups, in order to help progress the ecosystem. So I'll kick off by looking back on what we've done over the last couple of years. And it's important here to think of the idea of blockchain being a number of technologies. It incorporates, for example, shared ledgers, where you're just consolidating the idea of separate, disparate ledgers across different banks into a more logically coherent whole. And also, it's consolidating the idea of business logic, where each bank would historically implement its own business logic differently, and there's an opportunity here for it to be implemented once and then deployed across all the different banks. So some of the activities we performed, it started about 2 years ago when we got interested in some of the technology underlying Bitcoin. So we looked at everything from the virtual currency itself, right the way down to the protocols and data formats and the topologies of Bitcoin itself. And what we were able to identify was that there was a lot more opportunity to rationalize our operating platforms if we took inspiration from the technologies underlying Bitcoin. And as part of that process, we began by engaging with quite a few startups to get their opinions and to get inspiration from them. Some of those came from the Barclays Accelerator. So, for example, in London, different cohorts. There's a company called Cefello, which was a Bitcoin exchange. Another company called Chainalysis, which was able to perform analytical activities across a network in order to identify potentially AML compliant, KYC compliant activities. And what we did from this process is we also extended it to include other startups in the ecosystem. It was probably about 30 different startups in total that we engaged with. Some initial engagement was us providing them with our functional and non-functional requirements as a bank, and also them providing us with their opinions on how some of the current state could be disrupted. So it was a very on the leading edge of innovation suite of activities. We also engage heavily with various consortia in the blockchain space. So most people will have heard of the R3 consortium, about 70 banks in total. There are quite a few others. For example, there's the Post-Trade Distributed Ledger Consortium. There are about 50 institutions, including banks, exchanges. There's also representation from the regulators, such as the FCA in that. We're also working quite heavily with academia. Because this is so leading edge, we're looking to get input from researchers, which may be around the correctness, completeness, soundness of the different propositions. So, for example, we've been liaising with University College London, where we've been funding some researchers in their Centre for Blockchain Technologies. Also, Imperial College and Oxford University. No surprise that we've also been engaging with major vendors, for example, IBM on its Hyperledger fabric, and also Intel with its new blockchain platforms. One of the main goals of this during the last couple of years has been to understand the technology and the potential behind it. So what we've been doing is conducting experiments with these startups and the vendors and the universities. Effectively, they've been constructing proof of concepts that we can participate in and then see the results and get the learnings from that. It's very much an iterative, exploratory process. Going back to some of the fundamentals I mentioned, from a bank's perspective, we're looking at the two key features. One is how to share data more efficiently. So currently, every bank has its own internal books and records, its own individual ledgers, and messages are passed between the different institutions. Typically, they're an instruction to perform an activity. As a result of that, each bank then performs a whole suite of reconciliation activities to ensure that all their different ledger systems reconcile. The potential for a blockchain solution is to remove that need for a reconciliation stage. And that's radical. So before a few years ago, in the idea of Bitcoin and the idea of shared ledgers via distributed ledgers, the only mechanism to achieve this was a centralized shared ledger. And here you have the model, for example, with a clearinghouse, a central counterparty, whereby you delegate to them the rights and obligations to execute the transactions. And then the onus is on the banks to reconcile with that central counterparty. This model allows a distributed view of the data. And that's what's so radical. And it means that you can effectively have a view into that data to be able to participate actively with the data in terms of updates, potentially reg reporting, etc., on a common schema. And also the business logic that sits on top of it also being able to be common. So you can imagine, for example, in the same way that we have standardized legal agreements, for example, ISDA, for us to perform derivatives, OTC derivatives and swaps, you can imagine similar for smart contracts, where you can download the business logic and each bank could execute its vanilla business logic using that same code that was built and deployed once. That then leads on to another topic that some people have found quite interesting. So about a year ago, we looked at the different options in the blockchain space, the different design options. And as a bank, we were aiming to see, did we have a preference across these design options? And if we did, could we then give that back to startups and also central banks and regulators as our architecture position? So I'll briefly mention about 3 or 4 of those choices, and you can then get a flavor of what we've done in the architecture teams when we look at blockchain. So for example, if we look at digital currencies, there's a spectrum of digital currencies. At one end, you have the completely public versions on a permissionless blockchain. Bitcoin would be a classic example. As you move across that spectrum, you can imagine in the future there'll be a centrally banked digital currency, And by that I mean the tokens that flow around the network represent an existing fiat currency, such as a pound or a dollar. They're also backed by a central bank. So as a bank, our preference has been within the investment banking space for a centrally banked digital currency, which is why we liaise with, for example, the Bank of England as part of their roundtables and other initiatives looking at what model makes sense as a centrally banked digital currency. We can also look at some of the other topics in this area. So our preference is for open source software. In the press recently, the R3 consortium has just open sourced its Corda platform. And we're very supportive of open source and open standards in this space. However, when it comes down to the control, we think that it's necessary for there to be a level of industry control on the network instance that's created. And this is comparing it with a pure permissionless network where anyone can access it. You can perform denial of service attacks, a whole host of challenges. But if you look at existing networks, such as the payments networks, VocaLink, etc., that there's a capability to, and Swift as a good example, there are existing infrastructures that are quite solid that can be leveraged. Another really interesting topic, and this helps you refine which aspects of blockchain you're most interested in, concerns the level of consensus that's required. So many blockchain networks have consensus at the network level. Effectively, you're looking for over 50% of the network to agree on a certain next state, such that if any divergences from that occur, the majority continue on one that they trust. Now, when you drill down into financial networks and the agreements behind them, there's a natural level of granularity for consensus. And that's actually at the agreement level. And here you have your existing legal agreement, for example, for a trade. You may have a couple of counterparties. You may have some third parties, such as an agency or similar. But that's the legal level of consensus. So our preference has been not for consensus at the level of an overall network, but consensus at the level of individual agreements within that network. And if you notice the models that, for example, Axoni, Hyperledger's taking, Digital Asset, and also the R3 consortium, there's a flexibility of consensus options. So we've noticed over the last year, as blockchain has matured, so too have the design options within it. And they flexed a little bit from their original aspiration of a permissionless network with a virtual currency on top in order to hone down on individual agreements that banks can process. So, given all of that, what have been our focuses over the last year in the investment bank in terms of products in blockchain? Well, earlier this year, we publicly demonstrated an interest rate swap executing on a distributed ledger platform. We showed this end-to-end. Started off with the master agreements, the credit support annexes. We then entered a trade, then instantiated that trade on the Corda platform and showed it running. So at the time, that was the first demonstration of the Corda network running. But remember, that was just a proof of concept. We did that in about 3 months via the accelerator program in Barclays. So we actually put our own internal team within a cohort at the accelerator. So there were 10 startups and a Barclays team. We found it really useful to separate ourselves from our Canary Wharf skyscrapers to move over into the Whitechapel area and join a startup ecosystem. So we're able to do in about 3 months in that environment what would normally take, I would say, at least 9, 12 months, and then get a demo at the end of it. Some other products we've been exploring, equity swaps. So here we've been looking at OTC vanilla equity swaps, and we've been using the Axoni Core blockchain platform. So there's a press release about that about a month ago. We're really pleased. I think there are about 130 test cases that we went through, and it met all the test cases. So that's something we'll be looking to explore in 2017 as well. Other areas, so our loans business, particularly syndicated loans, is a good potential use case, a very common one. Everybody talks in this area. A couple of other things worth mentioning, cross-border payments. So most banks, if you were to ask them, list their top 5 use cases for blockchain, cross-border payments would be one of those 5. And Barclays is no different to the other banks in this case. Looking outside of the investment bank, worth noting a couple of months ago, our corporate bank executed the world's first trade finance transaction on a blockchain. And in this case, it was using a Wave platform. And that's a startup that went through the Barclays London Accelerator a couple of years ago. So the idea here being, the small startups go through the accelerator program and then can partner with Barclays for a project. And that project is then their opportunity to engage with other firms as well to build an ecosystem. So, looking back and summarizing what's happened in the last couple of years, hopefully you can get a feeling that what we've been doing in this space is open innovation. It's very much a case of engaging with many third parties, startups, consortia, universities, etc. Removing ourselves slightly from our classic investment bank environment, becoming part of the startup ecosystem. Where we perform experiments, go public about it as soon as possible. Make sure the startups have a halo effect as well. That major banks have been part of it, that it's executed, and to say what's viable about that proposition. So it's a little bit of a different way of working with the investment bank. And I personally really enjoyed the period that I spent for 3 months in the first quarter of this year running a team through the accelerator process. And as I highlighted, it got a lot of press at that time, a lot of, whether it's Reuters, CNBC, that, the list goes on, where their view was, is Barclays able to innovate by connecting with these third parties? Okay, so hopefully that's given a flavor of what we're doing. Any questions about what I've just covered? If I just open it up.
Does anybody have a question for Dr. Brian? There's a question here.
My name is Anant. Can you hear me well?
Yes, I can hear.
Great, thank you. So my question is about the blockchain underlying that you're using. Are you agnostic? You mentioned a couple of implementations. Do you have a preference, or are you agnostic to which blockchain implementation is being used?
Sorry, do you mind repeating the question? I can just about hear, but not.
How's now? Is it better?
Perfect.
Yeah. So my question is about the blockchain implementation. Are you agnostic, or do you have a preference for a particular? You mentioned a couple of names that you used or accelerated. And then are you agnostic, or do you prefer a particular implementation?
In terms of the technologies? Yeah, sure. So,
yeah, for the blockchain.
Yeah, so in the investment bank, we aren't producing a blockchain technology. We're looking for third parties to produce blockchain technologies that we can use. So if you look at, for example, a research paper that we published only last week in that called smart contract templates, essential requirements and design options. We highlight, I think it was 6 different blockchain platforms there that we're keen on exploring. So I would say our focus is on blockchain platforms that meet our functional and non-functional requirements, not any specific vendor.
Oh, there's another question.
Hello, I'm Ajay. I probably am not visible.
Hi.
I'm Ajay here. My question is, recently there was a major event in blockchain system. There was a consortium of approximately 7 banks which walked out from R3 CEV consortium, which was developing an open platform for global implementation, specifically for financial technology banking sector, where I think another group led by Goldman Sachs, which is promoting their Settlecoin on blockchain for replacing the Swift. So that was something, one major activity, R3's EV consortium, which was going to probably revolutionize the blockchain implementation across the world on a very, very mass scale. So would that have a bearing on 2017 blockchain? Because would that be a, do you see any technologies coming for mass implementation on blockchain, or do you see more of a symptomatic solutions to problems using blockchain?
Okay, so I didn't pick up all of the question due to the line not being perfect, but if I summarize the bits that I took up from it, was there are a whole host of different technologies during the last year or so, some of which have been patented, some of which are consortia plays, some of which are individual startups propositions. And I think the question was, do we see any particular ones in the next year or so going live, for example, with live products? So what we've been doing by engaging with many of these is providing what we view as the support and the input in terms of guidance for meeting SOAK testing and various other non-functionals in order to help these technologies mature. So if we look at, for example, the Hyperledger Consortium, there's a whole suite of different blockchain platforms in there, and that's growing. The R3 Corda platform is at a state where it's in a prototype format at the moment, or prototype stage. And that's similar, I would say, for most of them. There are some edge cases where people are live, for example, already, and an example there would be the Wave platform for a pilot. I would differentiate between being able to show one live pilot trade and being able to genuinely, repeatably commercialize it. So if we said 2016 was really the year of experiments and proof of concepts, then in this coming year, I would say it's maturing the prototypes, getting them ready for a pilot, and then assuming many of those technologies maybe towards the end of 2017, but into 2018 when there'll actually be a pilot ready for production, and then scaling that up will be subsequently.
Thank you. Thank you, Mr. Bryan.
Sure.
And thank you for your time. One more. We'll take some more questions at the end, or probably we can take your questions and email it to Mr. Bryan, and then he can reply back to you. Right. Thank you, Mr. Bryan, for all your time, and like another applause for Mr. Bryan for joining us from UK.
Thank you.
All right, just to take off from where Mr. Bryan was talking about collaborations and consensus and banks coming from skyscrapers collaborating with the FinTech community. So Barclays has done something similar in terms of creating Rise Mumbai, right? So what is basically Rise Mumbai? So it's a global community of the world's top innovators working together to create the future of financial services. Is there something that you look for when you look up at an innovation hub, a fintech innovation hub? Uh, is there something that you look for, like support, mentoring, anything from the audience when you look at an innovation hub? Okay, so I'll tell you what, sorry? Right. So collaborators, disruptors meeting under one roof and finding mentors and sessions such as these where they can pick up value, which will help to scale what they're trying to create, right? So this is what Rise has created across the globe, 7 sites, right from the West, starting from New York, London, Manchester, Tel Aviv, Mumbai, and Vilnius. We have got 7 sites across the globe. All sites are fintech hubs which are creating the future of financial services. Or what do we do there? I've been here. I think most of you have here. So we've got a co-working space wherein we've got fintech startups working out of this space. We've got the accelerator program, which is this Rise Labs, wherein, and the programs as well, wherein we help startups with mentorship, support, assistance, and partnership with Barclays as well. Uh, Apart from that, the Rise hackathons, where we try to solve problems related to the financial world, and Rise Radio, wherein it's an open innovation, again, an open source of information, just like the LTP website, wherein you have a lot of information revolving around fintech. This is all what we have achieved in the last 6 months at Rise Mumbai. So any of you, if are interested to know more about Rise Mumbai in terms of partnerships or co-working or the accelerator program, do let us know. We've got Prashanti here, Kainat, Soumya, and myself to help you guys know more about Rise Mumbai. So not taking much time because anyway, we've got delayed. I'll hand over the mic to the LTP co-founder.
Thank you. Hello, everyone. Um, I'm an ex-consultant, so usually I have a lot of slides to show. But today I'm not going to take too much time. We have 2 wonderful panels, and we have Mehul Desai talking about cashless today. So I'm just going to talk a little bit about, some of you might have this question that why do we do these meetups? Actually, a lot of people have asked me, what is the business model of these meetups? And they also have this question for the blog that we run, which is now, I'm happy to tell you that it is officially now the #1 fintech blog in the world, based on Alexa ranking and traffic. Let's talk payments.com. Um, First of all, thank you very much to the Rise Accelerator, as well as to the speakers and panelists who are going to talk today in the panels. Thank you very much, and thanks everyone for coming and spending time with us here. So we are into the business of creating insights and information and knowledge and sharing it. And therefore, we do these meetups because apart from the digital channel that we have where we get about 4-5 million page views every year, and we write about 35 different segments in fintech. These sessions actually allow to meet people, a lot of thinkers as well as doers in these sessions, and we enjoy it a lot. And we have got great feedback that we actually got into certain deals. We learned a lot of about our segments, as well as we met people whom we could hire or companies that we could actually join. So there are multiple objectives depending on where you are coming from the ecosystem. But these meetups are for information sharing as well as kind of networking. There are 2 topics that we are focusing on today, and I think I have got a lot of feedback on this, that these two topics have been kind of not there in a lot of fintech events. One is the RegTech, regulation technology, as well as blockchain. Um, so let me start with and talk a little bit about RegTech, although we have a session just next to this one. So I'm going to spend very little time on that and then talk a little bit more about blockchain and how we see things in this space. So in terms of RegTech, let me give you an example. If you look at a bank like HSBC or any other big bank, they spend about $1 to $2 billion on regulations, compliance, and risk every year. And there are now companies which are saying that maybe we'll be able to look at this and automate some of these processes. And a lot of them are mundane compliance processes, a lot of things on the risk side, as well as some new ways and new experiences that are also being built. For example, in the panel, you will hear about how there is a lot of work in India, especially around eKYC and digital onboarding that is happening. RegTech is a fairly broad area, and the term itself came only a couple of years back. And we actually wrote one of the first industry report on RegTech, which also defined, what does it mean, what are the various segments, and how big is the market. So we have a panel right after this, which my colleague Anshu is going to lead. And so let me leave that topic to the panel itself. The other topic that we have today is blockchain. And about 18 to 19 months back, we actually wrote one of the first research papers in the world on blockchain use cases. So if you actually Google blockchain use cases right now, that is probably the top content. And we have been trying to study that. We have talked to a lot of companies which are building some of those solutions. As Dr. Lee talked about the implementations, we have been talking to some of those companies as well. Today, I'm not going to talk about use cases, but let me tell you, just for the benefit of some people who might be uninitiated, who have not really looked at this topic very closely, let me just set a little bit of the groundwork on how you should look at blockchain. So, in a few hundred years ago in Europe, there used to be something called guilds. These were officially, or by the government, they were appointed to be the official printers. So you could not print if you were not a part of the guild. And over several years, now you can print at your home. You can print. You even have portable printers. So everything went from being very centralized to very decentralized, right? Um, Somebody who has built a very successful blockchain company once told me that if you look at a country like India, hundreds of years ago, we were primarily a rural society, right? So there were self-sustained villages. People used to just exchange whatever they were building. There was a barter system. And so it was completely decentralized. And over the last couple of 100 years, we learned industrialization and we kind of centralized everything. We now have banks, we have custodians. And then again, now blockchain aficionados are really trying to decentralize it again. So I see it as a cycle. And I think the blockchain panel, you will see people will discuss about use cases, and that's an amazing session. Another way to look at blockchain is that there might be many use cases, and there are almost I could tell you 10 use cases in every industry, but most of them would probably not see the light of the day because not all of them really solve the problems that a blockchain can solve. So a lot of people we are seeing globally, especially in a lot of startups, are trying to solve problems with blockchain that might or might not be the right areas to focus on. So there's both ways, right? There's a lot of enthusiasm. There's a lot of hype around blockchain. Since we wrote the research paper 18, 20 months back, there have been more than 6,000 articles on the use cases of blockchain itself. And I can't stop talking about like how many other articles are there. So apart from the hype, there are people who are asking this question, as Dr. Lee was discussing, that what will happen in the next couple of years? How many of these use cases can actually result in implementation? And I think that is one of the focus areas for the panel today. And with that, I would just end the short talk that I wanted to give and just get you started on, what are the sessions today. And I'm also very much looking forward to Mehul Desai's session. I'll give you a brief background when he comes to speak, but it's an amazing session. It's very timely as well because, what we have done since the early November on demonetization and its effects on cashless, it's a very, very important and relevant topic. So we are going to discuss that as well. It's sandwiched between the RegTech session, and then followed by the blockchain session. So now I'll just request Anshu, my colleague. She's the head of digital payments and cards at Let's Talk Payments, and she's going to moderate the panel on RegTech. And Anshu, over to you.
Thanks a lot, Amit. So hello and welcome, everyone. What I would do that to start with, I would request all my panelists to please come and take a seat on the podium, close to the podium. And let me start with Varun, who was sitting in the most comfortable beanbag across the door. May I request Nisha to please also join? May I request Arpit to please come on the stage? And may I request Manoj to also come on the stage, please? I would give a quick round of introduction, but I don't think so I'll be able to do any justification to the heavy credentials that all these panelists carry, and would definitely request them to introduce themselves. But before that, yeah, as Amit was talking about the RegTech industry, probably just a few facts to throw around so that all of us can relate better to what these panelists are going to share with us and throw some light on. So starting with the very much the report, the strategic analysis that Amit spoke about that we published at LTP some time back. Of course, it's actually the numbers, the sheer amount of money which has been either lost or it is involved in maintaining what we call the GRC, or the governance, risk management, and compliance, is something which is really overwhelming. So close to 40%, as we say, the penalties which have been paid for non-compliance, though we all know the history around that, have been related to the mortgage-backed securities. If you really look at the sheer numbers, these numbers are in millions. So the amount of money that the banks have lost in the last 5 to 8 years for non-compliance has been really humongous. So initially, though, the focus used to be mostly on being compliant with certain primary regulations. With time, there are so many of them which have come across the globe. There are certain global compliances. You have the regulations which are very regional, and at the same time, some of them which are very, very local in nature. The purpose, of course, mostly is about regulating the market, having more fair practices across all the financial services players, keeping the interests of the end customer in mind, people with probably less money, I would say so. But the amounts of dollars that the banks have actually lost on non-compliance really has been humongous. And that's one of the reasons that risk management, if I really have to look at some numbers, the amount of effort and the share of cost that is shared by the banks, or which is invested by the banks in the risk management area, is really humongous. If you really look at that, product innovation, of course, as we all know, is the primary driver for most of the financial service providers to invest in. Of course, after that, it's just digitization of the digital channels, which really steals the show. And of course, at number 3 is the risk management, regulation, and governance, which contributes to about 17% of the overall budget that these banks and financial service institutions, as we call the FIIs, actually spend on. So I'm really not going through all of the details in here, because I just very quickly want to skim through some numbers so that we understand the relevance of risk management and compliance that we're going to talk about with the help of our panelists. Again, a look at some of the numbers. Of course, they are in terms of the share across the globe, the various regions, the various continents. North America, of course, is expected to overtake Europe when it comes to spending on GRC, as we say, which is essentially what RegTech is all about, which is the technology-led GRC, or the governance and risk management. So the overall spending by 2020, it is, of course, an estimated figure. The share, if you look at the numbers, it's about over $50 billion dollars are expected to be spent on GRC, or primarily on risk management. And why do I say so? Once again, if you can look at just, they look like some bars, but of course the longest bar is that of risk management. So close to 1/3 of the cost that any banks or financial institutions are putting aside are focused on risk management, and that's where all the problems lie. Because risk management actually is a two-faced area, I would say. It is something to do with what you are doing to comply with the various regulations which are there, and at the same time preparing yourself for the future. And of course, technology plays one of the most important roles as far as risk management is concerned, and the most important ingredient there is data. Of course, we talk about data in terms of the analytics led fintech innovations which are coming into picture. But I think it'll be good to know currently what the banks, we have representation from two of the big banks, the global banks here with us on the panel. It'll be good to know what exactly do they think about the data and its potency, and where all they think that there are opportunities for us to look at this data, and probably with the help of the RegTechs, what is it they want to really address. Just again, going back to what Amit already touched upon, the typical in the shorter term, what most of the RegTechs are expected to do, and it's more of a perception, I would say, rather than really a hard fact, is that what exactly are they expected to do. So in the first wave, if I may call it so, they are expected to take care of more of the, as we call it, the mundane task, which is around doing the compliance related actions, creating the synopsis of the bigger, multi-hundred pages compliance documents, which are usually issued by the governing bodies and the regulators. And of course, at a very good important part of it is in the reporting side of it. And that's where we see that a lot of RegTechs are concentrating on really utilizing data and analytics to its right strength, and then actually trying to make it useful for the banks and the financial institutions. So with that, I have the pleasure of introducing our panel here today. I'll just spend a very quick minute in just introducing pretty much with the names, and I would request all the panelists to introduce themselves. So let me start with the lady here. We have Nisha Balani, who's the Vice President for Consumer Lending, Risk Data Strategy, and she's Program Lead from Wells Fargo. She's based out of for North Carolina. We have Varun Mittal on the panel. It's very difficult to describe him in like one phrase, but for now, he's the head for operations and merchant project for HelloPay, which is one of the most important fintech ventures of the Alibaba Group. We have Arpit Ratan on the panel. He's a co-founder for Senzi, and he comes with a very strong regulatory and legal background as well. And of course, he'll talk about his company a bit more as well. And we also have Manoj Kumar Kankaria, who's the Director for Investment Banking, Risk and Analytics Technology in Barclays Bank as well. So with that, may I just please pass on the baton, and probably Nisha being the lady, if I can request you to introduce yourself, and we'll try to see if you can give a quick 1-minute introduction for yourself, and then probably we can move on to the panel discussions after that.
All right, better? Oh, that's loud. Hey, thank you for having me, Aditya. I'm here. And it's funny because I was traveling and I happened to be in the city at the same time that this event's happening. So it's not like it was planned. My name is Nisha, as you mentioned. I have been working in regulatory, not per se technology, and you'll see sort of through our panel, but I've been in about this industry about 7 years. I actually was born in this city, and I moved to the States when I was about 14, and so I've studied in the States, and I ended up working in regulatory work because when I graduated, there was nothing else to do. This is all you did in 2010 when the economy crashed really, really bad. So I was with Bank of America, and you must have seen I was struggling with the charts there, but read all over. So a lot of work there last 6.5 years. And for the last 6 months, I've been working with Wells Fargo. I don't know how popular that is here, but it is one of the top 5 banks. And I've been doing data per se, data management, data risk compliance, and specifically for consumer lending.
Thank you. Thanks a lot for that, Nisha.
Hey, thank you, Nisha. Good afternoon, good evening, everyone. My name is Manoj Kankaria. I run risk analytics technology in India for Barclays. I have been with Barclays for about 3.5 years now. Before that, I was in US for 17 years. Earlier, my career was with UBS. I was running their prime brokerage in US on more on the margin side. And before that, I was in the technology companies. So thanks for the opportunity here.
Hi, I'm Varun. Thanks for adding that much stuff on the before. But I'm based out of Singapore. I'm running operations for HelloPay. Is a payments arm for Alibaba and Ant Financial for Southeast Asia. I've been based in Singapore for the last 8 years, running different wallet and payment businesses. Led Samsung Payments and Singtel Group Payments for Southeast Asia before. Very interested to be in the audience where India stack and all the stuff which India is doing in the limelight. Would love to bring a perspective of what happens on the other side of table, because I spend a lot of time with the regulators. So what all goes in their minds when everyone is criticizing them. So it would be good to talk about that.
Thank you, Varun.
So I'll just talk about SignZ. What SignZ does is we help financial institutions digitize their regulatory which can range from onboarding to background checks and finally documentation. So we have built a bunch of APIs and some products which will help you to do one of those three things. That's what we are. And very looking forward to this panel because I think as Amit pointed out earlier, I think this is one of the first discussions that I have come across in India on RegTech. So really looking forward to this.
Great. Thanks for. So they looks like networking, blockchain networking between the. All right, I'll just take another one. Thank you, Kana. Okay, yeah, I think it's a small room, so next time it goes off, I think I'll try and use my pitch, which anyway, I think Aditya concurs that is good enough to reach a good range. So let me, I think, start by asking Manoj, because we are talking about the banks and, how these regulations have impacted in terms of cost as well as non-compliance. So, even the global big compliances, not just the Dodd-Franks of the world, but also the FATCAs of the world, the Basel 239, and the MiFID 2. What this, of course, there's a lot which needs to be done to even just be compliant, forget about trying to be proactive and, do things differently and more efficiently for the future. So what do you see as, what are your primary expectations from these RegTechs when it comes to really dealing with, the compliances as big as, Basel and MiFID 2?
Sure. So if you really look at the regulatory landscape, it's quite complex landscape. There are, I think, 100 or 150 events which are happening on a daily basis, and everybody is trying to comply with them, right? So compliance and regulatory is a very complex aspect. Now, along with that, the implication of that is to comply, there is a cost involved for the banks, right? So there is an increase in the cost, as well as another landscape which is playing a role is personal liabilities for the management. So they are kind of accountable for all the compliances. If and then regulators are putting pressure that if you're not compliant, then probably you'll be sued or you'll be put in jail. So these are the complexities involved in regulatory world. Now, what I see is there are these big regulations which are coming in after, possibly some of the names you have taken, MiFID 2, Basel 3, BCBS 239, BCBS 261. All these regulations have been, part of the artifact after, the Lehman collapse, right? So every bank is trying to comply with it. I saw some numbers like HSBC is spending or employed about 25,000 people in the compliance world. And the same story goes across the banks. So if you really look at it, for the compliance, regulators are not only looking at complying to these regulations, but they're also looking at the same data or same information and the same processes are used across compliance, across regulations, across reports were generated from management, and so it's quite a complex world. And I think everybody's spending similar kind of efforts. So that's where I think RegTech will play a bigger part, in my opinion, where you can have the unified data, unified processes, unified controls, and unified reporting.
Great. I think that's a good insight that you bring on that, Manoj. And I think if I may continue with the same risk management for banks perspective, Nisha, the question goes to you. That of course it's very easy for us to put one $1 billion figure and say this is the amount which has been lost, or this is what is being invested in compliance. But as far as the data with banks is concerned, of course, I think they have the most biggest volume of the structured data. I'm not really sure about the unstructured at this point in time, because that really depends on the analytics engines of the organization. But what is it typically the kind of data that the banks hold, which they either have not been able to utilize or exploit to its full extent, or probably they have failed to utilize, either to comply better, with all these compliances, or to probably be more proactive and create innovation practices which are going to be beneficial. So how do you see the importance of data, whether it is analytics led or just sheer data in risk management in banks?
My God, very relevant question, right? So again, to your point, right? I mean, it's not a very simple environment, right? So you have to, the way, and we struggled with this at my previous company at Bank of America. The way we had to look at the blueprint, if you may, was in domains. We had to really break down the subject of the data by certain areas, but there was no other way. If you're talking about a smaller bank, even in the States or anywhere in the world, figuring out and blueprinting the data architecture of the space is much easier. But when you go through hundreds of years and at least last through 2 or 3 decades of simply purchasing and buying and constantly through mergers and acquisition, you tend to collect a lot of data that is duplication of systems. So to answer your question, the way we had to look at it and the way I look at it is that you have to break your data subjects down by transactional, derived, and reference, right? So you have transactional data, which is loan level, credit card transactions daily, wholesale loan transactions. Then you have reference data, which is your master data, which is your general ledger, accounting data, market data. Then you have derived data, which is, okay, based on the market data and based on my transactional data, how can I make sense of this? What's my risk on this loan? What's my risk rating on this loan? What's the amortization flag on this loan? So those types of data, right, those come under derived. Just to even get to this point, it took the industry a while just to organize the structures, right? And then to your point, BCBS 239 or even risk data aggregation clearly specifies that you must have your data aggregated, which sounds very simple, but it's extremely difficult for a large company. So you have to first start there, right? To your other question about what kind of data is untapped potentially, this is it. You have to really dig into your transactional data. Not only can you prepare reports for stress testing or 14A and 14Q, which are your quarterly and annual reports, but you can also then predict accurately loan losses. What are going to be your loan profits? Which products are going to actually succeed? Which products are not? To a point where there is now a new component. I can't remember the particular regulation, but we're also monitoring large deposits. Where are people moving their cash? Why? And how is that a variable or an input into what may come? Potentially trying to predict if we have a 2008 again. So there's a lot of that data, which you say unorganized, you say structured, non-structured. I'm going to use the word, not a tech word, I'm going to use a more regular English word, organized and not organized. Our data is extremely unorganized. Forget about structured and non-structured. All that's sexy, but it's not really happening in some of these large banks where a lot of the data is residing. So we first have to organize it. We first have to structure it, if you may, structure, but more so in the English term, not tech term, and then make sense of it. Like if you your model, your predictive models can only be as accurate as your base data. And we're struggling with our base data. So we have a long road ahead, but that's where I think we have to start.
Great. Thanks for that, Nishan. I think that's a very good insight that you bring in. I think Manish has a point to add.
Can I just, just one point actually on the unstructured data, right? So there is a new paradigm called conduct risk in the banks right now, where all types of risk are being actually monitored and trying to, uh, come with the plans to avoid those risks. So regarding the unstructured data, there is a lot of data like retention of the data, like your telephone calls and chats and emails and everything is kind of archived and also looked at. And that I think is a unstructured data you're talking about. And so along with that, there is also a challenge of cybersecurity, right? So all those things, I think there is a lot of innovation required in that space. I don't think there is a lot of innovation being done for the unstructured data, but there's a lot of innovation required. I think RegTech companies can actually, play a big role in that.
Great. I think that's a very good insight added to that. Thanks for that, Manoj. And I think though it looks like that you're sitting in the order, but I think it's the right time to pose this question to Varun, as you rightly said, trying to present the regulator side. Everyone just comes back and blames the regulator. You really are making things very expensive for us. There are too many regulations in the side. But sitting on the other side of the table, what exactly actually goes into the regulator's mind? Are there any global fears which they are trying to address, or what are the challenges that they are facing, because of which we see increasingly more stringent regulations, global as well as regional? So what's your take on that?
A regulator is just like a goalkeeper in a soccer match. Whatever he misses is what everyone talks about. Everyone talks about 2008. Does it mean regulators were sitting idle for the 5 years before and 5 years after? No, they were doing work. So in a regulator's position, whatever you miss, everyone will put a microfine glance and wrote treatises and wrote large essays in hindsight. It's very easy for people standing on the sidelines to make commentaries on the shores, saying, oh, if regulator might have seen this, then they must have done this. So it's very easy to comment in hindsight. All these models, you can have as much data and you can do as much prediction, but every prediction is based on a set of assumptions. And if all your predictions are based on your past data, then all the new phenomena and all the creative solutions designed on Wall Street would never happen. So there is a limited value which can be derived out of past data, but beyond that point, past data has limited significance in future. And from a regulator's perspective, let's take India's example. Everyone is complaining, oh, regulators should do more, RBI should do more. Think from RBI's perspective. There are 25 plus prepaid instruments in market. Each of them can be used on money laundering. 5 years ago, they had much less amount of money in it. Their staff has not increased proportionally to the number of wallets which has increased. Their staff, their technical infrastructure, even the technology available has not increased with that proportion. So you do not want to give them the right tools. No one is giving them the budgets to handle that much growth in the rest of the pieces, and they're expected to ensure no depositor loses money. So it is this scenario where everyone wants them to function, and everyone wants to complain about the salaries, about the budgets, and the bureaucracy. But when it comes to, okay, look at the headcount and the budget increase in regulators in last 20 years, year on year, compare that to the size of financial services industry, what is the difference in those growth rates? And I can guarantee you across countries, it would not be even 10th of the size of industry growth. So with that small capabilities, yes, automation can help to a certain extent, but you keep on having more and more asset classes, which is not wrong. But automation can help beyond a point, but humans have to intervene because humans have to define the rules. Because industry is creating new and new avenues, there you still need humans to create those rules. Robots only do what humans teach them to do. And whenever everyone complains, people do not think about all those challenges which a regulator is facing. Everyone is saying that they're increasing our cost. Look at the total cost of regulation as a percentage of size of industry. Do not look at it in sheer numbers. What was the size of total financial services industry in 1980? when you compare these numbers and do it a percentage comparison, then you will find a real comparison rather than absolute numbers.
I think that that's a very fair point made, and Varun, thanks for putting together that perspective from a regulator's point of view. I think in a similar way, probably a question that I will continue to Arpit is that Varun spoke about the parties. Of course, you have the regulators, and the reason regulators do what they do and what they are expected to do is because the markets increase, the number of players increase, and of course, the expectations that the customers or the end customer of all these institutions actually changes with time as well. So between these various parties, the banks, the regulations, and the regulators themselves, who is the who's really the custodian? Who's the custodian of trust here? Is it the banks who are most important, who are supposed to drive, or who actually drive what kind of regulations come in, either by negative performance or positive performance, or the practices that have been, of course, been the reason for the likes of Dodd-Franks to come into picture, or is it some other factor which plays a role? Because Varun has, of course, is talking about technology versus the human intervention and the superstition which also needs to be there. So what's your point of view on that? Who's really who's the custodian of trust here?
So I think I'll just pick up from what Varun mentioned, and I actually being a tech company, I still agree with what Varun says. Financial world overall depends on what you say is trust. The reason today I feel I have the faith that I can put a 1 crore amount in a bank is because I have trust in the bank. I mean, I don't know how many people use their wallets to the maximum extent. Which what I mean by that is your Paytm wallet can be loaded up to 10,000. So how many people actually deposit 10,000 at the beginning of month in their Paytm wallet? I don't know. I don't know. I have not heard of any guy who puts in 10,000 in the wallet. You put a minimum amount, you use it, and then you reload it again. That's how you use your Paytm wallet. Let's say tomorrow, what they're saying is they can make it to 20, they can make it to 1 lakh. But the question is, will you put 1 lakh into your Paytm wallet? That's the fundamental question we need to ask. And that is where I think regulator becomes the central piece of any fintech environment. What protects a fintech community, I think, is the regulator. And globally also, if you see the most viable markets are the ones which have a strong regulator. And the Indian debate, which is quite clearly, as Varun said, is dilution versus regulation. That's the perfect debate which is happening in India. And what I believe is that regulator is just trying to prevent fraud. It's a very simple, and all the regulations are a very simple function of this one purpose, which is to prevent fraud. And overall, I do believe that what technology needs to do is it needs to enable the regulator, not only the bank to maybe comply and regulate itself, but it also needs to enable the regulator to be able to prevent fraud. And therefore, somewhere draw a median or a bridge between the need to dilute and the need to regulate. Wherein, if we can have technologies which can provide trust, security, and prevent fraud, I think that's what the RegTech challenge is in India, at least.
That's great. I think that also brings in a very different perspective to how RegTechs are trying to address. So probably it might be a little unfair to expect Arpit to represent the whole of RegTech community. But I think one of the key questions which I see, which is coming in from hearing all the point of views, is that what is it the expectation from RegTechs? Are they expected to concentrate more on data, as the untapped data that we speak about? But going by Varun's point, there's only so much that you can learn from historic data, and what is happening is futuristic, and we have to be more predictive. So is it really the predictive analytics based, where the focus has to be better as compared to, let's say, how should I say, the fraud prevention, or ensuring that they are the genuine players and the identification of the people is correct, and they're the right set of players who are there in the picture to move around the money and play with the money? So what is more important? Is it the data or the analytics led data, or is it probably the identity management which has to be more important for RegTechs to focus on? And I think it's an open question for to all of you, because everyone comes with a different perspective. So what are your thoughts on that?
So it's like this: in a battle, you need intelligence to get the satellite pictures of where are the possible attack positions, and you need enough armor to go and actually fight the battle. So data is what you will fight the battle with, but you need enough identity and those informations to actually know where those people are, who those people are. So it's not either this or this. It would be depending on use case. There would be a balance between the two. In some countries, for example, I mean, India has a lot of identity advancement, but if you go to the likes of Philippines, Vietnam, their identity is so much weak that you have to rely much more on data. In India, you can rely much more on identity. So you focus more on that. Probably data has less value in Indian context, because not because data is weak, because identity is strong. So it is not either of the two. Every use case will have its own merit, and you have to run both of them in parallel. Either one of them alone cannot win the battle.
That's a fair point, I would say. And I think with that, would you like to add something to that, Nisha?
So I can speak from investment banking perspective. Uh, for us, the problem has been again the data, not having consistent data. Uh, s- the same information is not used across the processes, and that's a big problem. And I think we need to, what regulators are doing is, I think they are, in short term it's a pain, but in long term it's good thing, because they're trying to create the transparency. They're trying to cut the reports and cut the different types of information out of the same data, and that brings a big consistency in the banks. Thank you.
To your question about how can RegTech help, it's a very ambiguous question, right? Because the problem is not something you can pinpoint. To my point earlier, if it's a smaller corporation, like I don't know what you call here, federal credit unions or like government banks or smaller bank scenarios, you can go in and there are limited amount of regulations that a smaller bank is subject to, at least in the States. It's very clear. If you have more than 50 billion in assets, you are subject to XYZ. But if you're a smaller bank, then you are only subject to ABC. And also the sharpness of the examination is a little different. So when it comes to your question, how can RegTech help? I've seen a lot of startups or even smaller consulting firms trying to take a whole reg solution view, not the EYs of the world, but smaller consulting firms who go in and target smaller banks. And I have colleagues in these spaces, people I've worked with, and they've done extremely well, because they go in and from having no structure or no idea to having at least some baseline of how to understand these regulations, how to implement them, and even to a point to actually consider changing some of your products and innovating the products in a way that you don't sort of have to be subject to some of these regulations, right? So that's where the innovation is happening too. For the larger companies like what I've worked in, that's my only experience, this is a complex issue. It's a combination of, to your point, of people and also off-the-shelf solutions. I saw some of the logos up earlier too, and I'm familiar with only a couple of them, not a lot. But the problem is that we, at least to my knowledge, we have a lot of products that we can say, oh, this is data management, this is this, that is, it's very sexy, it's your one-stop shop. There is no such thing as one-stop shop yet. Otherwise, we wouldn't be here today. So we do have some solutions that we can take off the shelf, but a lot of it has to do with the lack of talent, one, and second is a lack of knowledge about some of these systems that are so dispersed, if you may, distributed, and so old in a company. So you have to find your gatekeepers. That's how I see it. You have to find the people who know the place. You got to get some talent on the street who understands how technology can help. And then you got to get some consultants to build an army. Unless we have these three things right now, I haven't seen a successful solution yet.
And I think that's a fair point, and that actually what makes it $100 billion industry, as we kind of pretty much claimed in the analysis that we did. So I think that I think very beautifully you concluded in terms of the expectation that the bigger financial institutions had from RegTechs. Just before I open it to questions for the audience, one more question which is coming to my mind, and I would like to address it to Arpit, is that out of these various enormous number of regulations that we have across the globe or the region or locally, is there a preference that the RegTechs look at, that which are the compliances that they prioritize over others, and probably are there any reasons or any thought process on why is it done?
See, currently, I think the way RegTech has developed, at least in India, and that's what I can talk about, is that there are low-hanging fruits. There are places where banks have been either using a manual force or have been outsourcing it to a third-party vendor. And this involves regulations, involves risk mitigation, and a lot of these processes can, one, be automated, and in the second case, can be simplified using technology. And that is where most of the innovation in India is happening in the space of RegTech. But once the another thing, what is happening, I think very interestingly in India, is that I think the biggest innovator in India in RegTech is actually the RBI. I think it has innovated more. It is the first large institution which has brought a paper on blockchain in India. I don't think any bank was talking about it before RBI started talking on it. As way back as 2015, they were talking about blockchain. They almost forced the banks to at least start doing testing with the blockchain technology. In fact, one of their directives to EDs was that blockchain is really good, artificial intelligence is really good. Please start using it. It's like one of the directives from RBI, and therefore I feel that at least in India, the path is very, very clear. RBI, in its judgment, in its view, is driving RegTech in India, at least in the financial sector. And all the technologies or the startups have to do is understand the regulator and at least try to understand what's going to be tomorrow and just implement it. I think it's very simple. It's very simplified in India by RBI itself.
That's great, and that's a fair point as well, Arpit. So, Varun, what's your view on that? If I just expand beyond India and let's say talk about APAC, because which is known to be the most, I would say, the innovative region, not just in terms of growth, but really in terms of the true innovation which is coming in. So, what's your view on that?
It's two simple things: don't be the largest and don't be the loudest, because then you get the most of the attention. And the whole idea is a lot of so-called startups or regtechs are so enamored by magazine covers and Facebook coverages that they would love to make some outrageous claims which they cannot back, and to mock at some of the existing institutions. Those are the stuff which actually doesn't add anything to the bottom line. It's just the glamour part of the business. So if you want to do serious business, you can pick either you want glamour or you want serious business. Probably some of them can. I mean, if you want to do both, then you have to be the biggest, then you can do the glamour. Else you will be caught between the crossfire. And because the way it works is, regulators also do not have time to go and regulate everything. It's only when you make way too much noise, then they have to notice you. You're forcing them to notice. It's like there is a priest which is doing meditation and you keep on dancing around, making too much noise, you will get noticed. Or you can peacefully do your work. There are too many sandboxes. It's probably not enough for a startup to go do every sandbox. You can do small stuff. You can actually make a product, make a business before you make too much noise and dances around it.
Great. I think that's a very fair perspective brought in. Thanks for the simplicity of it, Varun. So with that, I will just open the forum for questions. If anyone who has questions for our panelists.
Hi, Arpit. My question is, so interesting, I see that you all are into the space around identity management. So identification and background checks. My question is around going paperless. What is the stance of RBI and regulators on going paperless? So there are certain types of documents, especially coming from a capital bank, capital market background. There are certain types of papers, for example, the stamp papers on which the trading happens, as part of the trading, those which cannot be really converted into e-documents today. So what is your experience and understanding of RBI stance around that?
So actually, the stamp paper is regulated by Revenue Department in each state, and RBI will just say that whatever is your stamping method, that's the law. So the person who actually regulates stamping is the Revenue Department in each state. Now, some of these states like Maharashtra, Karnataka, Haryana, Rajasthan have already moved into e-stamping. wherein you can pay stamp duty online. And I believe in India, everyone will follow that example. So eventually, I think that that's not going to be a problem. And as I said earlier also, in India, the regulators are going to drive the innovation. We just have to follow their suit, and they are driving it. So this will go digital. That's not an issue at all.
Andhra Pradesh is embracing smart contracts for this. So the state is building a platform where smart contracts can be stored and used between multiple entities. So then the whole traditional stamping and the inspector Raj can be minimized, because then it's state-owned infrastructure for all kind of contracts.
Thank you. Thanks for the question and thanks for the answers. Any more questions?
And some specific area where major amount is being spent as for the non-compliances by throughout the globe. If you could just, anybody could take this, I mean, some classical example of
Latest example is 1MDB, $1 billion scam in Malaysia, impacting Switzerland, Malaysia, and Singapore. So the president siphons off $1 billion money from the sovereign wealth fund using classical money laundering features, bypassing all the best security features, taking down private banking license of 2 Swiss banks based in Singapore, jailing off few bankers, firing off few, significant cash penalty on DBS and UBS banks in Singapore. It's a fresh, less than 6-month-old scam across Southeast Asia, impacting all the way from New York to Singapore.
See, Sciency could be a solution to some of the problems of financial institution, as he's come out with some product, right? About the background and a verification check kind of things. What is it that a financial institution would really look for in a startup, that they really feel that we need these kind of solutions for our business processes? So, as from some kind of innovative community who could come out with some solution for your requirement. Okay, yeah, we particularly looking in this area. Okay, we really need it. We'll on for it, like say something which is really required by you guys in some area. Okay, this is where we are actually spending a lot of amount, and we need to cut this, and something we get in terms of some innovative solution. What is it that you would actually look for? I mean, some area of your interest. Yeah.
So this is not a new topic. I think all of you, regardless of the country, can relate to this, is anti-money laundering. We've talked about this briefly today. It costs so much to innovate for us in a larger bank. And the people and the talent and getting the approvals for hardware, and it's just like moving a ship in a lake. And sometimes we're so occupied with more hot and heavy topics that some of this, we call it BAU, or business as usual. Anti-money laundering should be something we should be able to detect systematically, robotically almost at this point. And yet I don't think the industry has come to that point, right? So I can mention a friend of mine, or someone, a colleague of mine who used to work at Bank of America, who left and started his own company, a startup in my city, Charlotte, North Carolina. His name is Abhishek, right? Tresata. And you guys can look it up, Tresata, Tresata. And that's all he does. He's AML startup. And he started just about a few years ago, 3 or 4 years ago, and he's gotten huge, he's gotten hot, he's gotten everywhere, he's been published. And it's very simple, right? His model is, I'm not gonna offer you 10 different things, like you were saying, right? Is don't be loud, don't be big, but try to concentrate on one thing, is anti-money laundering, and trying to predict that better and better and better. And as bread and butter or regular it sounds, even now, if an Indian company were to come up with a pretty good, robust, hey, it works, it may not be sexy, but it works, you will sell. You will sell globally, and you will sell well. That's just my opinion.
Thank you. Thank you so much.
Thanks for that answer, Nisha and Varun. I have one more question there on the audience.
So, I mean, all the conversation that was happening around the irregularity of the data, the inabilities of the regulators to have enough staff to be able to monitor all this. isn't this all crying out loud for a distributed ledger, a mechanism by means of which, because anyway, I mean, customers wanted to bank with banks for confidentiality, right? And with the kind of openness that is being sought, there is none anyway. So isn't this all crying out loud for a distributed ledger mechanism?
I think that is the next topic, I believe, for this session, blockchain, right? Yeah.
So there are two global projects working on this direction. Canadian and Singaporean regulators are exploring, is there an opportunity to put their currency on a distributed ledger? So that, because right now, if you look at the total currency circulation is about 3% of the total asset value in a country. Technically, this room is an asset, but its value is not in circulation, it's locked. So they are looking at how they can digitize the core of it, and then it can flow from there. So when you have to think of something like this, you are looking at, if you start to digitize, put distributed ledger everywhere, things will fall apart left, right, center. It would be a mess like demonetization, where you start once and you have no idea what will happen. So which is why the core of all of this is the currency. You start at the currency layer. Can you digitize the issuing of that currency? Today you go to a bank issues you a loan, and he gives you a real currency. Every small bank can issue you a loan, and a regulator may find out 3 months, 4 months, quarterly, when the audit happens, was this bank even allowed to issue this much issue currency? Can you control the issuance of currency at the first step? And then it can step by step travel across the rest of the pieces of the industry, where every bank, when they have to issue a currency, it goes to the central piece and it's regulated from there. You start it from there so that you don't throw a neutron bomb into the system and wait for what things blow up. You start from there and slowly it will travel. Distributed ledger is just a technology solution. And technically, a traditional Oracle MySQL database could do all the things if the challenges were the ones we are looking at. Yeah, but distributed ledger, if there is too much data and half of them is not organized, distributed ledger is not going to solve it. So if the problem is that there are silos of data which don't talk to each other, or there were M&As and there were different data structures post M&As, distributed ledger is not going to solve it. So distributed ledger is not like panacea.
I may have a different opinion. I'm not going to say disagree, but I have a different opinion because, so I don't know how many of you know, but SAP actually implemented in the financial industry, I'm going to say NoSQL almost, ledger with Bank of America. It took about more than 5 years. I was with the company for all that duration. And I think if you guys know the history of Bank of America, has always been buy and duct tape and buy more and duct tape and buy more and just tape it up and let's go, let's go, let's go. There was never a pure integration. Hey, let's look at two systems. Which ledger is better, Merrill Lynch or ours? Let's just stack it up together for now and let's move on to the next venture. And when we were hit really, really bad with our regulatory requirements, one of the biggest things was we have to take care of multiple ledgers. And SAP won that ticket. Took a long about 5.5 years, like I said earlier. But my point is, it went from all these sub ledgers in the bank, which were duplicating sources, right? So you have loan balance on your auto loan portfolio coming in from one ledger, and then you have 5 other sub ledgers feeding it. Well, nothing's aggregating. Your reconciliations are off the wazoo, and that's where we were being caught up with our own pants down. And so that integration of removal of a lot of subledgers and past fleet merger and Merrill Lynch, like I said, so many, when that was consolidated, it is kind of like a NoSQL, but I think some of you techies can argue that it's not really a NoSQL. I'm not really close to that domain, but it is very much so in a way that it is a distributed ledger. Now, if this can be duplicated in some other bigger banks, if they need it, then yes. But like my current company, I don't think we have that many issues because we were known, Wells Fargo was known for expensive and slow mergers because we actually took the time to compare the systems. We sunsetted a system that was less better or inferior, if you may, and kept and actually integrated it, right? So companies who have not taken the time to really merge properly will certainly have to do what you're saying, right? But companies who have taken the time to integrate them have an advantage. They can then now start banking on that data because it's all sitting in one place.
I think we just have time for one more quick question. Let's go to the lady in the back.
Yeah. Hello, good evening. I have a quick question for you, Nisha. In September, your CEO, John Stump, resigned. My question is, why did it take so long for the scam to come to the fore? You know, millions of fake accounts were created and
is it time for me to go?
out of all your regulatory compliances in place and a very tight regulatory environment, why did it take so long?
I knew I was going to answer something around this before I walked out of the door today, so I came a little prepared. Look, there's a lot of views on what happened and what should have happened, what could have happened. But here's what I know as an inside person of the bank, right? This was detected a long time ago. We knew it. The bank knew it. Top management knew it very well. We were openly discussing it with the CFPB, the Consumer Financial Protection Bureau, who happens to be the loudest right now. Absolutely, yeah, absolutely. We'll pay that, and we've done that. Right, it is all over the world, to be honest. Yes, very much so. And so the point is that we knew about this a long time ago. It was known information, and we were analyzing all the accounts that were being questioned. So the numbers that you heard in the media, or some of you are probably Googling it right now, or like about 2 million accounts that were in question. That were in question, not that were flagged as fraud. And so we were analyzing, we had actually hired a third-party consultant company to come in, do evaluation, do an audit on these accounts. And the ones that we knew the origination for, we kept them in a bucket. The ones that we did not know the origination, that doesn't mean that they were originated by fraud, but the ones that we did not know were put in a bucket. So the ones that we did not know is what makes up that 2 million accounts. And the government actually, due to political reasons, in my and my company's humble opinion, given the elections were very timely after that in my country, had pressure to sort of publicize what they had been doing to protect the consumer. And so this information, this negotiation had been going on for 3 years. And all of a sudden it was revealed as if we had no idea about it in the media. And the perception is what I think in hindsight we could have done better. I think we could have managed public relations better as a company, and we take full ownership of that mistake. We acknowledge that. Our CEO acknowledged that. Like you said, he resigned. He also refunded a bunch of the bonuses that he earned in those years. But it was also, if you think about it, without taking too much time, I'm not defending per se, but I'm just simply stating facts. I'm also new to the company. It was only about 5,000 or so employees over a course of 4 to 5 years that were let go. So it wasn't like we rounded a bunch of people and said, off you go. It was more through time. And it was also very regional. It was only in a region in California and also another region in, I think, Mexico. So proportionally, it was a very small event, but no excuses to the fact that it was fraud, no excuses to the fact that maybe we or a RegTech company could have helped us detect it better. Hint, hint. But yeah, it was certainly something that we are not happy about and not proud about at all. And we are working very hard to gain consumer interest and trust again.
Great. Thanks for that, Nisha. And I think I'll have to apologize to the rest of the audience who have any questions. Probably you can direct them over email and we'll send it across to the panelists and get the answers. So I would just like to very quickly wrap up and thank all the panelists for this fantastic insight that you brought into this very first panel discussion that we have on this topic. And I think it's pretty obvious. I don't really have to conclude that the amount of opportunity which is available because of the two very important sensitive aspects which are involved here, which is reputation as well as money. So both the things, of course, make it all the more important. And this particular field is a very promising area for us. So look forward to many such more panel discussions and inputs from our esteemed panelists as well as the audience. So thanks a lot for your time today. And I hope to see you soon. Thank you very much.
Thank you.
So thanks, Anshu, and thanks to the panelists. I'm very happy and honored to have Mehul Desai as the next speaker. Mehul has, back in those days, in late 90s, he actually started the digital wallet journey, and he has a patent for one of the first digital wallets in the world, which he later evolved into a mobile wallet and then into a container of commerce journey. And the company was called CSAM. It was built by Mehul Desai and Sam Petroda, sold to MasterCard in 2014. Mehul has done a lot of pioneering work into digital transactions, and we are really delighted to have him here. Just a few more things about Mehul. He's the founder and CEO of Desai and Company now, is also an expert in residence at Chicago Innovation Exchange. He's based out of Chicago. He's traveling here. Is also on the board of several companies such as Botree, Personal Black Box, Pias, and Switch. He's also advisor, investor, mentor to us at Let's Talk Payments. Uh, and I cannot miss mentioning this, that he actually wrote 3 very interesting books. The latest being August of Money, the Quest for Cashless Society. And that is also the topic for the discussion today. And I would like to invite Mehul to the stage, and please talk to us about the cashless journey.
Thanks, Amit. Good evening, everyone. Sorry, I'm fighting a little cold, so if there's a little echo, it's not the sound system, it's my voice. Thank you, LTP. Thank you, Rise Mumbai, for this opportunity. Back in November, IMTC, which is the International Money Transfer and Payments Conference, invited me to speak in Miami. They asked me to come talk primarily about August of Money, which is the book Amit made a reference to. And the title that they had asked me to speak to was War on Cash. And so I've kind of essentially used the same topic. I think it's very timely. Coincidentally, the day I had to speak in Miami, there were 2 big news items. So as we woke up, that was the day that India announced its demonetization, which was, of course, news for all of us of Indian origin and those who have ties to India. And then also it was the same day that Trump won the US presidency. So clearly, in terms of competing headlines, August of Money we had no chance at all. That said, this is a topic that is kind of close to my heart. I have been, again, as Amit mentioned, I've been working in this space. I'm not a banker. And in many ways, looking back, if I'd known everything that I do now after almost 25 years, I don't think I would have started working in the fintech space. So many a times ignorance is bliss. But in many ways, what I'm going to talk about are largely observations that I've had collected, I would like to say, across most large markets around the world. And that's just what it is. They're mainly observations, and I'll try and give it a little bit structure as we go along. So first off, what exactly is the war on cash? And essentially every time you ask someone this, something very different comes up. To me, it starts with cash. I think we all can relate to cash. But the minute we start talking about cashless, which is essentially what the war on cash is about, Cashless brings up very, very different, embodiments. Some people view cash as a token, and in many ways, it absolutely is a token. A lot of times, and I will argue very shortly, but a lot of times cash replacement is actually misconstrued as cashless. Clearly now, with a lot of focus on Bitcoin in particular, we heard references to that earlier, and I'm sure there will be a few more with the next panel. Virtual currencies typically get kind of used for cashless. Data is clearly the new cash. Data is not cash, so is data cashless? And then finally, if you ask an economist typically will describe cash as either store of value or exchange of value. We long ago, as a global community, kind of moved away from store of value. So in the current context, is cashless exchange of value? Is it value exchange? And so I think the first question really is, how exactly do we want to define cash? Because then only can we start working towards figuring out what cashless essentially could look like. The one thing that I will pick on, and I'll come back to the others shortly, the one thing I pick on all the time is cash replacement. So I think we all understand cash well. We all talk about cashless. But most often what we are doing, even as we're doing it today in India with all the hype around mobile wallets, e-wallets, electronic transactions, is actually not cashless, it's cash replacement. And many times when I talk about cashless, immediately the reaction from the audience, from the people that I work with, people I talk to, is, aren't we already cashless? Well, actually we're not. And the reason that we're not is that true cashlessness is about total exchange of value. So effectively, if I were to give you a token, and if I have to pay more into that token for you to end up with the same value, then it cannot be cashless. It's cash replacement, but it cannot be cashless. The simplest way I can describe this in a very layman term is, if I give you a 100 rupee bill, I think 100 rupees are still legal tender. So if I give you a 100 rupee bill, essentially you get 100 rupees. I'm giving up 100 rupees. For you to get 100 rupees, I don't have to pay 102 into it. If I give you 100, you do not end up with 99.5, 97, whatever that number is. And that's precisely the point that I try to make with the difference between cash replacement and cashless. So anytime when you have an exchange, and if you do not have complete exchange of value, it's good. It's serving a purpose, clearly. This is not to say that that's bad and should be stopped and we should not do it, but it is not cashless. And so that's one of the first things that I like to highlight, saying there's cash. I think we all understand cash. There's cashless, which I don't think anyone yet has quite moved towards. It's used a lot. We talk about it a lot. But then there is predominantly cash replacement, which is really what all of us are doing. And we, again, do it for very good reason. And the key reason why when I give you 100 rupees, you end up with 100 rupees is because it's backed by the state. It's for no other reason. So when I give you that 100 rupee bill, the state government of India backs it up, which is why you accept it, you like it, you take it, you don't question it, you run away with it, whatever it is. That essentially is the only reason why it works. And so that's the key point that I'm trying to make here, saying that if you really want to move to cashless, it is critical that state fiat be involved. Without state fiat, it's cash replacement, which is good. Cash replacement essentially is a private endeavor. It's a value-added service. I use credit cards all the time because I love the airline miles that I get with it. I use debit cards, but these are not cashless, they're cash replacement. I think when you look at the history of cash, and I'm not a historian in that sense, but as far as the book and some of the other work that we've done is concerned, some of the early instances of using a token go back to cowrie shells, which was roughly about 5,000 years ago. Clearly, there was some kind of exchange, barter, some variation of barter well before that, but most historians still point to cowrie shells, which roughly was about 5,000 years ago. And if you kind of look at the evolution all the way up to Bitcoin in the current context, clearly we've evolved essentially how we all view exchange of value. I won't call all of these cash, but essentially look at how you evolved exchange of value. I think Marco Polo is the one who wrote about Genghis Khan, saying when he came back, and this, there's historical proof around this, saying that one of the most interesting things in Genghis Khan's empire was essentially what he described as cash, but in the current parlance, it would be more like a traveler's check, saying it was closed loop, it could be used across the kingdom, it was stamped, and essentially you didn't have to lug around a lot of stuff if you wanted to conduct trade. And if you really look at it, the only reason why that worked was once again because of state fiat. If Genghis Khan's seal was not on it, essentially no one would accept it. So historically, in my mind, every time there has been some kind of a token which has scaled and scaled relatively well, invariably it always comes back down to state fiat. And so this is one of the key themes that I start with in the book. And by the way, Amit, there are 2 books, not 3. But that's okay. I'll take the extra credit there. So a few years ago, actually, Sam and I, we wrote a book together called March of Mobile Money, where we essentially looked at how mobile money was progressing. And at the time, it seemed to make sense. Not many people were talking about it. The idea was to sensitize people essentially on mobile money. And one of the things that we learned in the entire mobile wallet journey was what we view again from the outside as forced convergence. So if you look at kind of where mobile wallets, electronic transactions at large sit right now, in many ways, the most interesting thing is it's forced 3 very, very large industries to figure out how to work together. Telcos in terms of distribution, telcos, handsets, OEMs, kind of that whole sector. Clearly payments, whether it's the postal bank, whether it's a traditional bank, it's a credit card company, it's a prepaid company, doesn't really matter, the payment industry in general. And then most importantly, the service provider, the retailers, service providers. And in many ways, this forced convergence is something which no one really saw coming. There's really no way you can map it out. And in many ways, even now, the frictions that we see, and I again, just this morning saw an article in the Times of India which talked about fraud with e-wallets and all kinds of stuff going around. A lot of that has to do with forcing these 3 very large industries, which typically don't work with anyone except themselves, to come together. And so that's one of the first things that we focused on, saying, what exactly does this do? The second thing is, again, the theme that I laid out earlier, which I think is an important one, because until we all recognize the fact that cashless is very different from cash replacement, there cannot really be any meaningful debate about, how do we start building cashless? So we all have to accept, and I would like to believe a lot of us will, if not most of us, that cash replacement is distinctly different. Once again, this is not a rant against cash replacement. The cash replacement industry has been very good to me, so I'm thankful for that. But this is clearly to say that that's a value-added service. Cashless, in my mind, and again, I keep arguing this, is more of a public utility as opposed to a private value-added service. Central banks have to issue currency in bits and bytes. And this is kind of one of the key tactical themes that I try and lay out in August of Money. A lot of talk about regulators in the earlier panel. I've also had an opportunity to work with them. As a matter of fact, Aditya and I both have had the privilege and pleasure of being on a task force that the Federal Reserve and the US pulled together several years ago. It was a very interesting experiment, been attempted anywhere else before. Not to kind of talk about anything which is classified, because these were closed door sessions which they ran for many years. But if I had to describe it, it was like a gym teacher having a fight after school hours behind the gym to bloody your noses, but not allowed to kill each other. But nevertheless, have worked with few other regulators as well, RBI in particular, Mexican regulators, People's Bank of China. And all in all, I do agree with some of the points which were made earlier, that their job is an extremely difficult one. And clearly, for those on the outside, they kind of come in and they have the luxury of kind of, pulling punches and making punching holes. But in my opinion, until we get to a point where central banks start issuing currency, literally, the paper and the coins and the plastic and whatever physical form that currency is in right now, literally in bits and bytes, there is no way we can evolve to cashless. So for us to evolve to cashless, they literally have to start issuing the rupee bills, whatever denomination they want to. I won't go as far as saying that there needs to be one common global bank. I think that's kind of utopian. But I do believe that it's relatively straightforward. I definitely believe that it's not going to take about another 5,000 years for that. I think it's relatively straightforward for central banks, if they really want to start issuing their currency in bits and bytes. And the beauty of issuance is it forces settlement. And I think as a room full of predominantly fintech or bankers, I think all of you will agree to this, that if they build it, then the rest of the ecosystem will absolutely come. And that's the key thesis that I have, again, at a very tactical level, that if they start issuing currency in bits and bytes, then the entire settlement infrastructure around it starts evolving. Now, for a minute, if you think about this carefully, you have e-wallets, you have m-wallets, you have the lifestyle containers, the best example of which is something that I use in Mumbai all the time. Uber is a great example of a lifestyle container, saying this is about going from A to B. The payment happens seamlessly somewhere in the background. And today, all of these rely in some form or the other on cash replacement. They have to, because clearly you're not going to push a rupee bill inside your phone to make that payment. If they had instead the ability to take APIs from RBI, if they had the ability to take APIs from the Federal Reserve, let it run country by country, because that's the only way you can effectively build this. That would change the entire economic model of the service that they provide. And this isn't just about large established providers like Uber, which can essentially eat up that cost as part of their business model. You can imagine now the kind of transactions that the government here is talking about, saying you pay your bajiwala and you pay the shoe shine guy and whatever it is. All of that starts to look not only viable, it starts to look very different. So at the end of the day, all of this can work, simply put, if the central banks start issuing APIs. I know I'm being overly simplistic about it, but at the same time, I absolutely believe that it can be done. The key building blocks, in my opinion, are already in place. The first one, which kind of doesn't roll off your tongue that well, what I call contextual experiences for secure enabled ecosystems. These are essentially the mainstay of all these lifestyle containers, saying that you have the ability to now secure disparate domains. It's been happening. A lot of us have been doing it. And absolutely, it's getting more and more savvier. And there is no reason why you cannot leverage that as one of the key building blocks. The next one, also, which has been going on for a very long time, again, the Federal Reserve in the US essentially uses a politically correct term called near real-time settlement. So they can't say real-time settlement because in reality, it's not real-time. They don't want to be dragged into court over that. But they call it near real-time settlement, which is good enough. It beats the batch mode FTP kind of settlement that I started doing for banks almost 20 years ago when I started working in the mobile wallet space. And if you look at the next gen banking infrastructure, it is already there. The key building blocks are in place. Doesn't mean that everything's perfect. Doesn't mean that there isn't room for abuse and misuse. All of that will always happen. But nevertheless, it's absolutely there. And then the third one is clearly math-based fiat money. I don't like to use the term virtual currency because I don't think it's the same thing. I absolutely stay away from using Bitcoin because Bitcoin is three very different things. And effectively, the term that I would rather emphasize is math-based, but fiat money, saying that if there is state fiat, and if it can leverage the math-based know-how and technology, blockchain as a distributed ledger clearly is one of those building blocks, not necessarily all of them. You have, again, another interesting third building block. Three different developments together, and you pull them together, I do believe the key building blocks are very much in place, which doesn't mean that it can be announced next quarter. But at the same time, I don't think this takes even 50 years if you really had the political will to do it. And then the most important part, kind of moving to the strategic, is I believe cashless impacts everything. So I predominantly view this as a technocrat. I'm not an economist. I'm not a banker. But I do believe that this goes way beyond just normalizing the cost of capital. It goes all the way towards things like national security. As part of the work that we did for the Federal Reserve, we actually were called into some national security forums as well at the time. And so net, I know for a fact that the minute you start moving away from cash and you're not bogged down with kind of the distraction that cash replacement creates and effectively start moving to a true cashless environment, a lot of things start to unlock in terms of the potential that goes with it. Switching gears again a little bit, the early days of e-commerce were really clearly just about commerce. But that said, I think over the last at least 10 years, we ourselves were involved in a lot of different experiments which use the same core technology for healthcare, for education. Clearly, retail and finance kind of dovetail into each other. And then finally, on the government side, for government applications. One of the interesting things I had an opportunity to do here in India was to work on distribution of the National Rural Employment Guarantee Program at the time. So this was almost about 7-8 years ago when the program was first announced. And we were part of a pilot with India Post, where we put our technology to play just to distribute the money which had to be paid to those recipients. So net, the point again that I'm trying to make is, if I had to take a larger perspective, and this is again one of the things that I'll end tonight's talk with, I would not limit ourselves with just financial services. It's important. Clearly, we're in a Barclays facility, so we have to absolutely should start talking about that first. But I think finance moves to retail, retail moves to healthcare, healthcare moves to education, and education moves to government. And as far as I'm concerned, until you take a larger, more holistic view of transactions or personalized transactions, you really cannot start laying out the right kind of architecture for all of this. And that's really the term that I try and use, which is the e-plumbing. So yes, it's about technology, absolutely about business. Without business models, nothing is sustainable. It's absolutely about the regulatory environment. It's about compliance. But at the end of the day, to me, if I could take a step back, and in an ideal world, if I could pull all of this together, it really is about separating the utility from the usability. Once again, if you take these 5 key verticals, finance, retail, healthcare, education, and government services, to me, irrespective of what part of the world, what demographic, what your social strata is, these 5 more or less summarize your secure personal transaction needs. And everything is more or less a variation of these 5. And the underlying requirement to drive these 5 from all 3, technology, business, and compliance, clearly becomes the utility. There are a lot of common threads over there. And if you all had the ability now to stop bolting on stuff and instead looking at this, kind of saying that, okay, how do we build this brand new infrastructure moving forward? We clearly would architect a utility layer very differently, on which we could then start building usability layers, which clearly are going to be more local and would be more sectoral in terms of the applications that they would drive. But until you have the right delineation between the utility and the usability, I don't think we can have any meaningful progress towards cashless, in particular, secure transactions at large. Also, the other interesting thing that I've observed is, most often we tend to club adoption and scalability in the same sentence. Many a times we use them interchangeably. To me, these are 2 very, very different constructs. So once again, going back to the utility vis-a-vis usability route, to me, utility essentially ensures scale. Usability is the one which drives adoption. And only if you have that separation of layers can you actually now start looking at a meaningful way, saying that what are the factors which are going to drive adoption for the usability, and what are the kind of factors which are going to drive the utility, and ensure the scalability for it. One of my favorite ones that I pick on all the time, not to kind of read through the whole list here, is customer service. And I think we most often tend to overlook customer service. Back in the early days of putting our mobile wallets out, just like everyone else, we had spreadsheets which started at the top saying that if there are 300 million subscribers, we of course will end up with 250 million. And then if we multiply 250 million by 10 transactions a day, those are a lot of transactions. What no one really paid attention to was the customer service that would be required, the customer support that would be required when you get to that kind of scale. And it is impossible in my mind as a technocrat to build the right kind of customer support if I view all of it from a usability standpoint. It's impossible to do it. So until the utility opens up a bunch of capabilities for me whereby I can drive that kind of customer support, expecting the last mile to deliver that kind of customer support it's a foregone conclusion. It's never going to happen. So again, if you take this lens and you view a lot of the things which are going on right now, especially every day, I think in the paper, there is some kind of a commentary for and then against e-wallets and mobile wallets in particular. To me, all of them still come down to not having the right architecture in place, saying that where is the utility layer, what are the key things which come from the utility layer, and then where does the usability get built on top of it, and effectively, how can we remove a lot of this friction which comes up. And so finally, how do we make peace with cash, right? I think we all understand we're at war with cash. Let's instead start worrying about how can we make peace with cash. To me, it really comes down to saying that the real embodiment of cash and the virtual embodiment of cash have to sit side by side. So for a minute, if our central banks start issuing currency in bits and bytes, this is not to say, and in India, you never know, they might say, okay, all currency in physical form is over from tonight, and from tomorrow morning, it's all bits and bytes. They're capable. I think we've seen stuff like that happen, so I wouldn't rule it out anymore. But in all seriousness, this is not to say that physical currency stops and virtual currency starts. This is to say that both need to be there. But the sooner the central bank puts out the virtual form of currency, with the right state fiat, with the right participation, clearly with the utility, the usability, all of that in place, I think essentially the entire socioeconomic model around this starts to evolve and change very differently. And with that said, clearly, we have to view cashless more as a public utility vis-a-vis a private value-added service. I think that's critical. So while the cash replacement community already publishes APIs, you can accept them in all forms, physical as well as virtual. Until the public utility side of this picks up, I don't think we can really start calling ourselves cashless. If we're going to do that, we absolutely need to adhere to a broader definition of transactions. Like I said earlier, this should no longer be limited just to financial or retail transactions, because the utility layer is going to permeate across all 5 vectors. In my mind, a global utility would be driven largely by public players. This is not to say that the public institutions would do all of this by themselves. I agree with something that was said earlier, that RBI is one of the more progressive central banks around the world, especially given the kind of challenges that they face, in India. But at the same time, they don't have the answers for everything. But that said, they are the ones who absolutely will have to drive the utility in terms of not only defining it, building it, and eventually putting it out there. That said, the usability is very different. I don't think public institutions need to be in the usability business at all. The usability is going to come from 2 guys in a garage to you name it, because they're the guys who really have the pulse of that last mile. So effectively, there can be a global utility, and there absolutely has to be a local usability separation over there. And then finally, I said this in Miami, and predominantly a room full of bankers thought this was pretty funny. But I do believe the banking industry has an identity crisis. Most often when things are going well, we all love our banks. We kind of tend to look at them as a private enterprise. When things are not going well, we all of a sudden start viewing them as an arm of the government, and they become a public utility. And I think at some point, we all, not just bankers, but all of us have to decide saying, you can't be both of these at the same time. You can be one, but you absolutely can't be the other. And because banking is such a critical vertical as part of cashless, not only in terms of defining it, but also distributing it, I think until this identity crisis is resolved, a lot of the friction will continue to be there. More so as we start moving to real cashless. The second point that I've listed over there is we absolutely are now in an age where we can define, or rather redefine, by store of value and also what we mean by exchange of value. And in many ways, if you think about all the digital technologies that we play with, some which now are more or less mature, as in we all take for granted, and a lot which are still evolving, we can essentially stretch exchange in so many different ways, and we can stretch value in so many different ways. And that's all that I would look at a potential utility for, saying that it gives me the ability to build the usability scenarios that I want to, so that I can accommodate that stretch of exchange and stretch of value. One of the simple examples I use to kind of highlight how exchange and value get stretched are airline miles. Most of us, I think, accumulate airline miles. Most of us use them either for ourselves or people that we know. I'm not aware of anyone who gets taxed for airline miles. And by the way, I'm thankful for that. Let's not say that too loud. We don't want to be taxed for airline miles. But my point is, airline miles have monetary value. And a lot of other things which have monetary value get taxed. Why don't airline miles get taxed? The point is, can I use airline miles for transactions beyond just flying? And yes, I can. When I want to buy stuff from their store, they let me use their miles. But can I use it to now do barter and trade? And essentially, that's the point that I'm trying to make, that you can now stretch exchange and you can stretch value in so many different ways. And I think that's the beauty of having the utility and the usability separated out. And clearly with that, new behaviors are going to come up, new models are going to come up, different kind of tokens will absolutely evolve. There will be a lot of abuse, there will be a lot of misuse. But one of the points that I make all the time is it's always better to be proactive than reactive. Because frankly, if we as the well-meaning community do not put this out, then someone else is going to put it out and we'll all be forced to react to that. So with that said, I'll wrap up. Once again, thank you LTP, thank you Amit, Aditya for the opportunity. Thank you Rise Mumbai. Great facility, by the way. This is the first time that I've been here. And thank you for having me. And I don't know if you have time, but if we do, then would love to take your questions.
Yeah, anybody has any questions for Mehul? Okay. Let's get the mic there.
So my question is that there are countries like Sweden and Norway who are very advanced in terms of replacing physical currency, right? They're almost 98% there. So how are they adopting some of these concepts, and are they really looking towards cashless economy?
So I can hear you well there. So part of Sweden is doing, from my perspective, it's all not necessarily. Okay, please don't kind of interpret that as being bad. I just view that as cash replacement, which is all good because it's always one big step forward. The one country that I have singled out is Estonia. And so it is a country in the EU, right next to Finland. By Indian standards, it's not even a town, let alone a country. Its population is roughly about 1 million people. But the reason why I singled out Estonia is because of all the different experiments that I've seen in this direction. Estonia is clearly working towards building a common utility. Again, the kind of utility that I'm looking for. They haven't started doing cashless, but they do have a common utility essentially saying that, look, all finance, retail, health, and government services, I'm not familiar with education, but these four will run off a common set of infrastructure. And they're already seeing tremendous benefit with it, from tax returns to you name it. So I have singled out in the book Estonia, saying that if at all there is a place where you want to look at a proof of concept, it's a proof of concept at best because it's 1 million people. But clearly that would be the one. But everywhere else, so Canada also has been doing interesting things with putting tokens on smart cards to essentially start taking cash out of the system. In many ways, and I said this a few days ago because, while I'm in India, demonetization comes up practically by the hour. And someone asked me saying that, look, what does this mean? And I said, to me, games did for the adoption of television sets in India, I'm hopeful that 5 years from now, we all will look back saying demonetization did that for mobile wallets in particular. To me, it doesn't matter whose mobile wallet, the government has theirs and private providers have theirs. But I'm hoping that once we kind of get through these turbulent times, and early days of this are bound to be turbulent. Because frankly, at the end of the day, there's only so much you can do to plan for something like this. The rest of it, you have to just take it as it comes. But I'm hoping that 5 years from now, we will look back at that, saying that if this step was not taken, 50, 100, maybe 500 million people would never have been forced to adopt mobile wallets. Now, going back to your question, what does that do to the kind of experiments that Scandinavia, Sweden in particular are running? I just don't know. But the kind of scale at which we operate, and I'm optimistic about this, I think we will blow all of those away by comparison. But that said, the journey for cashless, still continues, because that's still going to be very different.
Hi, my name is Yash. I'm a digital head in an NBFC, and we are basically into tier 2, tier 3 lending more, wherein most of the stuff of lending happens offline. So
I'm sorry, what is MBSC?
my NBFC company, it's Fullerton India.
Okay.
So I represent as a digital head over there. So in tier 2, tier 3 segments is where most of my consumer lending is happening. Now, I just saw your slide about bits and bytes. If RBI starts doing that at an API level, do you think fundamentally we are back in the age of connectivity at those places? Because if I don't have connectivity, then there's nothing which I can do while exchanging value. So if I have to lend somebody and I have to put money in his account, and there's no LTE over there or there's no 4G connection, you see that is a stumbling block. And if yes, by when do you think that will be closed so that we can move to something which you suggested over here?
Okay, so I won't get into the weeds, so I'm going to take a philosophical view. For me, the glass is always half full, and I now say this with some basis in this. So I've been deploying technology across markets for a very long time. I put mobile wallets out there way before the term mobile wallets meant anything to people. And what I learned the hard way is that the addressable user base can never be filtered down. The onus is on us as innovators. It doesn't matter if you're two guys in a garage or a large organization. The onus is always on us to come up with a solution whereby you can do this, right? So having great connectivity, would it help? Absolutely. Can you do 10 more things? Absolutely. Is your risk mitigation going to be better? Absolutely. But does that mean that without that you can't do anything at all? I disagree. I don't think so. I think there is absolutely a place where you can start, and then you can just keep building on top of it.
Just a follow-on question. So fundamentally, when we suggested that it's a cash replacement economy, that's where the cost is involved in transaction. So in this case as well, when you have connections, when you have internet or broadband, there's a cost involved on that side as well, right? So then...
Absolutely. I mean, let there be no illusion. Okay, and I got into this with the Federal Reserve of San Francisco. So in the US Federal Reserve System, the Federal Reserve of San Francisco is the currency one. They deal with the physical money in the US. And so there's a huge cost with cash. All around the world, there has to be, right? Printing the stuff and putting it out and then bringing it back in and shredding it and putting more stuff out. Who do you think bears that cost? We do, as taxpayers. It's a public utility.
No, sorry. My point was, if we go for the cashless, wherein API, all that also has some cost with respect to servers, API connection.
Absolutely, there will be. That's exactly what I'm trying to say, right? That there will be a cost to that. There is a cost with cash. Why should there not be a cost with cashless? Just because you move from cash to cashless doesn't mean the cost goes away. All I'm trying to say is that cash has a lot of cost, which is borne by the citizens because it's a true public utility. Cashless, if it has state fiat and if it's set up by the state, will also have a cost, which also will have to be borne by the citizens as the taxpayer base. And that effectively is how you're going to stand it up. So whether it's the cost related to the APIs or the servers, which are relatively simple, or it's the ongoing cost with whatever it is, okay, there will be a cost, absolutely, but it'll have to be borne just like any other public utility.
Yeah, hello.
No, I disagree, right? That's precisely what I'm trying to say, that cash replacement right now, because it's a private service, effectively you either pay into it or you don't end up with the complete value. I just looking at the, no, I don't think I disagree. On the contrary, I'm saying there is a cost with everything. There's a cost with cash also today. I mean, just because there's a cost with cash, do you stop using cash? Yeah, you still use cash. Okay, you don't have the luxury of saying that, okay, I'll take that 2,000 rupee bill because it's a lower cost currency than the 100, whatever it is. The point is there is a cost with all of them. Okay, the business model around cash, and I would like to argue cash replacement, if it is backed by the state, is going to be very different compared to the business model around cash replacement.
So what do you think is going to be the lag?
Yeah. Yeah. Hello, sir. First of all, thanks for the app and the exact description on the difference between the cashless and the cash replacement. I am also early believer of Bitcoins, and so at the end, in one word, if you want to describe the complete system and the complete August of money, or what you say, the cash replacement, virtual currency, data value exchange, whatever. So would you like to sum up that Bitcoin is the answer for this?
No, not at all. Not at all. Not at all. So I'm not a proponent of Bitcoin.
Okay.
I appreciate blockchain. I also think that blockchain many a times is a square peg which is being forced into a round hole. So it's not here to solve every single thing which is happening under the sun. But none of this, as a matter of fact, I don't think I even use the term Bitcoin in that sense, right? So none of this is construed as Bitcoin. Bitcoin are three different things. One is it's an exchange of value, and in many ways it's exactly like PayPal and a lot of other schemes which are out there. PayPal lends well to certain use cases. Bitcoin lends well to certain use cases. If you see the value in using Bitcoin, you absolutely should use Bitcoin. Bitcoin also is a technology play, right? It's the blockchain and the technology which kind of stands it up. So as technocrats, we all gravitate towards that aspect of Bitcoin. And then finally, it's a security. A lot of people trade Bitcoin the same way they trade equities and bonds and stocks and whatever it is. It's a security. They buy when it's low and they sell when it's high and whatever it is. Most often when we talk about Bitcoin, the audience muddles up all three. I am not referring to Bitcoin at all. So none of what I've said is about Bitcoin. Now, what I am trying to say, if I had to answer your question differently, if there is one thing that I'm trying to highlight in all of this, that is precisely the exchange we were having earlier, that until central banks around the world start offering up cashless as a true public utility, we will not be at real cashless. We'll be doing lots of interesting things with cash replacement. The business model will work in many instances, may not work in some instances, that's fine. You know, we live with that all the time, but we will not be at cashless. To get to cashless, I believe you need state fiat, and what that means is the central bank has to issue their currency in bits and bytes. That's the central theme. Valid question. I think a lot of states are grappling with this. Some states collect this blatantly and don't even give people like you and me an opportunity to openly talk about it. Other states do it covertly, and when they're forced to talk about it, then they fumble some kind of an answer. I don't think there's a simple answer, right? So absolutely. 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 So take your pick, right? All I'm saying is that to move to real cashless, we need to do this. I'm not saying it'll happen tomorrow. You know, at the core of this, from a utility perspective, is identity management. I think a lot of issues around privacy have to do with less about access to my personal information, more to what am I getting in return for my access. And there have been interesting experiments run at scale. You know, again, coming from the US, what I experience all the time is how the travel security guys deal with this. Back in the day, they used to get us to strip everything. Now they profile us and we can walk in and out. You know, what is it? It's not an intrusion on my privacy. What I'm being told is clearly, if you give up your privacy, this is what you get in return. No, so what I'm trying to tell you though, is those are not reasons not to go towards cashless. Those are valid reasons. We need to figure this out. Okay, it comes down to identity management. It comes down to how do you want to treat privacy.
Sorry, we will have to cut this off, please. You can take this offline. Thanks so much, Mehul.
Okay.
Thanks for the talk, and thanks so much for all the wonderful insights. And so this is one of the events which is actually running on time. So continuing with that, Anshu, yeah, thank you.
So again, in the interest of time, I would request my industry colleague Bhuvan to come on and moderate our second panel discussion today. I believe the much awaited one on blockchain. So why don't I request Bhuvan to please come on stage and also introduce himself. Thank you.
So, hi everybody. Thank you for being here. I think I can see people are. We have already dwelled into blockchain in a lot more ways. I think we have touched upon that topic. Sorry, quite a bit. I can see people are tired too, to some extent. So we're gonna keep this. So I'm gonna keep my session real quick, and then we're gonna move to the panels fast. So blockchain, what we call is unchaining the future. It's actually ironical to the name what blockchain suggests, right? I think there's been a lot said, discussed, spoken, experimented about blockchain. So I will not start with what is blockchain and how it works and what consensus framework and what smart contracts. So blockchain today, right? I mean, at this stage, basically, right? It's not a new kid in the block, right? It's been there. Gartner put that put that technology as basically the top hype cycle in 2016 report. I'm sure there is a lot of meat after that hype, and we'll see that in our conversations today. Blockchain has initially when blockchain started, right? I mean, people sort of made it synonymous to Bitcoin. But I think with the way people are sort of, discussing, understanding the information, I think blockchain has came out of the shadows of Bitcoin, and I think we're truly sort of realizing what's possible with blockchain. So I was looking at the social media post which says blockchain is one of the most searched term after Game of Thrones. And I'm a big shot. I mean, I'm a really hardcore Game of Thrones fan. I don't know how true that is, but I'm sure it certainly is very sexy. People are feeling that it can solve all the global warming problem. Obviously, that's not possible. But certainly, it gives us a tremendous potential from a tech perspective to solve or transform not just business processes, but the entire socio-economic fabric, right? From payments, from the way governments work, from the way regulators work, from the way this public utilities and services basically done for the citizens entire, and obviously the corporations, the way they provide various business services, I think it's going to just transform everything. So I think we had Dr. Lee talking about various use cases in terms of what Barclays is doing, right? In terms of equity swaps, syndicated loans, securitization with various blockchain-based platforms. And he said that 2016 is more like a year of POCs, right? I mean, various people, I think people like us, we downloaded that Ethereum from the GitHub, right? And created our first smart contract with the Ethereum Go. And then we saw a lot of other companies like Symbiont and Chain.com, and I'm sure there are 20 more, right? They sort of forked from the Ethereum core and tried to solve various gas and consensus framework and mining time and various technology problems, right? I think, so 2016, we are like trying to understand the technology, experiment with it. It's more the year of POCs. Now, what we believe is 2017 is the year where, is the year for the early adopters, right? The people, whether it's a fintech company, whether it's a bank, right? There's a lot of meat in terms of how they identify the problem, which can really be solved by blockchain, and then solve it, right? There'll be a tremendous first mover advantage, right? Key pillars of success. I think blockchain has been like sexy in the industry, right? So every fintech company wants to come up with a business model. They say, okay, we are a blockchain-based startup. Banks want to showcase that, okay, we are replacing our legacy system with something like, something similar to blockchain or something around blockchain. But I think it's very important to identify the use case. And I think somebody mentioned in the conversations before that it's very important to identify the use case that is the blockchain right technology, or do we really need the blockchain itself to solve the problem? Or can typically your distributed database bases like Amazon Web Services, I think, can solve most of the problems. I think So it's very important. So what are the success pillars for blockchain, right? So blockchain really brings potential and value when there is an ecosystem, right? And a fintech company or a bank can influence to create that ecosystem, but unless you bring the regulators on board, I think nothing's going to move really from a really, I mean, getting something into productized. A common service standard is very, very important, because we are not talking about some of the public blockchains which are started by Bitcoin, and we are now seeing that public blockchains cannot be really adopted from business process perspective. There will be private blockchains or more like hybrid blockchains, right? What we see is that various companies or regulators or institutions or governments will come up with various blockchains, and they need to talk to each other, right? And that's where the real power of blockchain can be realized. So a common standard is certainly the key to integrate, right? And the technology, I would say, I mean, any technology, right? I mean, when internet started in 1995, right? People said that it might gonna just get used only by US military. It's gonna eventually die. There was an article in 1995 in Newsweek stating so. And what we see today is internet has truly become pervasive, has become facet of every part of our life, right? And that has not happened over a year or two. It took healthy 20 years to get that transformation done. So I think we need to give blockchain technology that kind of time to get it evolved, right? So again, I don't think that it will take 20 years, but it's certainly, at least let's give it around 4-5 years more to see the real potential, right? So obviously the lot of laboratory testing, real life experimentation is required, right? In terms of adoption, I think Dr. Lee mentioned, Amit mentioned some of the use cases, right? Like, so some of the low-hanging fruits, right? KYCs, AML, remittances, payments, trade finance, clearing settlement are like sort of low-hanging fruits which can immediately, I would say, blockchain can bring a lot of immediate value. There's a lot of lesser dependency because you can silo those problems, apply blockchain-based technology and get benefits out of it. And because blockchain today is very resilient, right? The technology is very resilient, it's very robust, but it's not scalable. It cannot support your low latency electronic trading transactions in blockchain the way it is today, right? It has to go through a lot of testing. So when we see that, these early adopters get success with KYC, AML, and some of the use cases mentioned here, post 2020, we see that, when the blockchain technology evolves, I think there is a lot of need to get it, to the mainstream high performance computing, moving to blockchain based applications and infrastructures. With that, I will take a pause, and I would like to invite the esteemed panelist on the stage, please. Yeah. Okay, I think. So again, I'm going to follow what Anshu did. So I'm not going to introduce you guys in a detailed way, but just to touch upon. So we have Ritu Kedia from Barclays. He's a VP and part of the CTO architecture group. We have Harsh, who's co-founder of Algorithmics. We have Makran, who's the CTO for Hexanica. And we have Nitin, who's the CEO of Opus Consulting. I would request you guys to sort of give a brief about what you have been doing, a bit of introduction of yours.
Thank you, Bhushan. So I'm from the CTO team of Investment Bank of Barclays. I'm from the same team as Lee Brain. I'm one of the lead architects, and my functional specialization is in the post-trade space for capital markets. So I look after settlements and reconciliations, and also all the other related areas for post-trade that surround confirmations, affirmations, regulatory reporting, taxation, etc. So that's where my interest in blockchain lies. Just one thing I'd like to mention is that we are currently one of the internal teams, in fact, the only internal teams, opportunity to kind of be part of the first cohort of Mumbai Rise Accelerator. With that, I just pass on to you.
So hello, I'm Makarand. That's the third guy, okay? So I'm Makarand. I'm a techie. So I worked for Microsoft for 23 years in Seattle, came back to India 2 years back. I was one of the early developers on Excel, which is the first RegTech solution in the world. And so I used So I used to use it for in DOS days, just before Windows 3.1 days shipped. So old-time programmer. After I retired from Microsoft and my daughter joined, so I came back to India and then met people from Exanica, who are mainly bankers who are trying to solve the RegTech problems and blockchain and technological evangelization and getting my hands dirty with, turning the nuts and bolts and see if the damn thing works. That's my job. That's why I'm a CTO. So thanks.
Hi, I'm Nitin. So over the last 5 years, I've predominantly been focused on this whole digital transformation stuff that's happening. So basically, I call myself as a hunter for digital disruption cases. Been doing that when I was working with Persisted and now with Opus in the fintech space. And been also mentoring a bunch of startups in different areas. So that's what I'm busy doing these days. And I'm pretty excited by all the disruptive technologies, and blockchain, I think, is going to be one of them that are happening in the fintech space.
Hi, I'm Harsh. I'm basically a blockchainer for the last 5 years, and I've been researching into blockchains for 4 years and actively developing products into blockchain. And one of the key products that we have been working on is Chetas, and that's KYC over the blockchain. And it's basically an identity management solution.
Thank you, guys. I think I haven't done my introduction, so I'll take that opportunity. Bhushan Sonkuse, I've been in the industry for 16 years. I was working with banks most of my time. I was CTO for Bank of America Merrill Lynch in their fixed income, currency, commodity, emerging markets. I joined recently Publicis Sapient Consulting. I'm leading business consulting portfolio for India, and I handle the fintech engagements too. So with that, I think let's get into our discussion. So let me take an opportunity too, if you could continue, right, what Mr. Lee said, right, in terms of what Barclays has been doing, right? If you could give us much more detailed flavor in terms of what use cases, what sort of platforms. I think there were some of the questions in terms of what sort of blockchain platforms have been used, right? What are the journeys? What are the experiences so far? What are the bottlenecks which you guys see, and what is the sort of roadmap ahead?
Sure. So I'll begin with just reiterating the areas where Barclays is actually currently involved in experimentation on blockchain. So, we are basically working on the most common use cases, which I think the entire industry is working on, that is trade finance, syndicated loans, all the use cases, where it is very paper intensive process and the trade settlement time is pretty high. So, going paperless and really establishing the proof of existence on blockchain, that's where we're seeing, a lot of experimentation happening. And in fact, we are already moving into production and plan to move into production in the year 2017. So you will hear some news announcements of Barclays putting trade finance in production in these years, in this coming year now. And these technologies that we have actually built upon for these areas are based on the platforms that actually emerged out of our previous accelerator programs. I don't know if you've caught the company names, so there was one which was Wave, which came out of our London accelerator earlier in I think it was year 2015. There's another company which was Telestix, which is dealing with finance invoicing on blockchain. So, these are the platforms which we've actually taken from our accelerator, and we are going to put them into production. The other areas where we are also doing work, where we are working with other consortiums of the likes of Exoni and R3. So we have already, you might have seen the press release from Exoni around the credit default swap and the equity default swap use cases. Now, the interesting bit is, which I'll come to the second point around, what are the challenges that we are seeing in the adoption of this and really taking it to production. So credit default swaps, equity default swaps, the trade finance, the syndicated loans. The interesting one, which which is one of the flagship areas where Lee's team is involved, is around the smart contract templatization. So currently, if you look at most of these, the blockchain areas and the implementations, it's a lot around, digitization of the existing processes. However, the legal documents that we're trying to convert into smart contracts, if you see currently there's a duality. So the legal document itself, the legal prose is being maintained separately, and the smart contract is actually duplicating that logic, but there is no validation that's really happening on the legal contract. So this is an area where Barclays is kind of a pioneer. We are closely working along with academia as well as industry in establishing a templatization and a language, a common language that could automate the legal contract so that we don't have a duality between the legal contract and the smart contract that is driven off the terms and conditions specified in the legal contract. Now, coming to your second part, which is around the challenges, I think there are three areas where I would like to highlight the challenges. One of them being around, we're talking a lot about, application of blockchain to finance, where privacy, it's about cash and really large amount of cash that we are talking about, and well-established financial systems for so many years that we're trying to replace. So privacy is a key. Personal experience, so we are also involved with a lot of experimentation. I don't think the industry is mature in terms of the underlying technology stacks to really handle those aspects. So you see that there's a lot of open sourcing that is happening right now. So R3 recently on November 30th, they open sourced their Corda platform, which is specifically designed for financial industry. And there are several other forks of Ethereum that have come up in the market. So JP Morgan, they built their own fork called Quorum, which they open sourced recently, which is also replacing the consensus model and the entire privacy model underlying Ethereum, because Ethereum is a permissionless public blockchain. So we see a lot of that movement that's happening right now, but I don't think the industry is mature yet. And I see a lot of potential over there in this year, where we would see the development, you would see actual Ethereum being released, which is mainly for enterprise. So that's one of the areas which is essentially around privacy. Then the second aspect is around the ecosystem, which we've been talking about, right? Blockchain in itself, it's a distributed ledger. So unless you have that ecosystem, that distributed ledger doesn't make sense. So I think in the coming year, you would see that, at least in 2017, you would start seeing the application and productions where that ecosystem is more internal to a bank. So you would have use cases, where there are multiple legal entities part of the same bank, where the competition and the privacy aspects, are kind of handled. They are less significant, basically, as we move into production. That's second area. And the third area is around the integration with the internal systems. So, with blockchain, the challenge is when we are really talking about blockchain, how do we really identify what is the starting point of really replacing our existing legacy systems? And how do we kind of integrate whatever we put in with our existing systems? So I think that's where, a lot of focus is going on in terms of understanding, how do we really integrate it with our internal systems?
Thanks, Ritu. I think you brought some of the really very practical and very profound points. So let me change the side of the table and move to Harsh. So Harsh, so some of the points which Ritu mentioned, right? Security, privacy, maturity, scalability of the technology, right? And you're building this startup called Algorithmics, which I just suppose more KYC ledger sort of thing. So what's your viewpoint sort of on these points, on these issues or challenges, and how you plan to handle them and cater them?
Firstly, it's I'd like to point out that blockchain brings a fundamental shift inside the information systems, and that's the main point. And as Mehul mentioned in the previous talk, that identity becomes a key component. When identity, it's like not just the organizational identity, and it's the identity of the person that is there. So if you put that identity over the blockchain, and that's where we are working on. Also, the point is, as Ritu mentioned, that you have serious privacy concerns. These serious privacy concerns can be sorted out by using certain mechanisms like homomorphic encryptions and so on and so forth.
Thanks, Harsh. Makaran, you want to share your perspective on that?
Yes, hello. Yeah. So for me, I'm an old man. So I think of all these things with a pinch of salt. I've got two things in my mind. When you have a hammer in hand, everything looks like a nail. So now that we have this thing in hand, we try to hit everything with it. That's my one take on it. Second take is like Hadoop. Hadoop was the buzzword 2 years back. It still happens to be a buzzword in the industry. Wow, what is so different about Hadoop? It got distributed processing. Well, this happened in Windows 1995 screensaver called Rosetta, when it used to do the molecular calculations for Stanford University across multiple machines. This was the first instance of Hadoop. Well, we don't call it Hadoop then, we used to call it distributed processing. Similarly, blockchain. Think of blockchain. When you ever do authentication model with any server, which has got a other domain controller talking to it, this is the first instance of blockchain that worked since 1980s. It was not called blockchain then, it was called distributed authentication. Okay, so what is blockchain today? It's a new nice name for the technology that has been there for 30 plus years. I don't see it extremely innovative at all, frankly speaking. I think it's a great packaging of old technology which existed for years and years. Like Samba, for example, if you work on Samba or even Windows DC protocols, they talk across multiple machines and validate identity. They have got their SAML claims sitting on top of it's a blockchain. It's not called that. So my take on it is that yes, blockchain is going to solve, but since one more thing, because there is a lock, there has to be a key to it. So security is going to be always an issue, irrespective of how many bits of encryption you go through. Agree?
Do you wanted to add something on that?
Well, maybe not later, not now, just now, but yes, it's a good technology to have. And how should I use it? I've got few use, a lot of people told some interesting use cases. I think Mehul stock was the most, what do you call it, publicly acceptable use case of the money cashless. And the best use case of that. What will you require to do Mehul's vision in mind? Huge computing power. And everybody in the world will have to be a validator. Because I cannot stock that. I've got trillions of transactions, trillions of cashless things running around, and somebody has to validate that. Am I passing these 10 cashless things to her? Are they really my cashless things or his cashless things? So somebody has to validate, and the speed of the computing, speed of the internet, whatever connectivity you want to call it, is going to be interesting. And if you solve that, no problem. Maybe go telepathy or something. And so my take on it is yes, it's a good. So where would I use it? For example, today, as it stands. Yeah. A couple of takes is that when the reporting in the reporting industry, there's a huge amount of auditing that happens. So typically, a lot of reporting people here who know better than me because I'm not a banker, but what I hear from the bankers is that Bank of America scenario that she told, they acquired 20 banks and one guy is running on Oracle, other guy is on IBM DB2, third guy has got some old DBase file still running around. They put all those together. Now, let's take the example of something like FRY9C, which is the loan reports, which is apparently like how much money did you make on housing loans for single families in last year. And that comes from like 17 different banks in 17 formats. And they say, okay, we made $100 million. Fed asks, oh, last year you made only 50. Where did you make more money? I said, we don't know. It came from 17 systems. And then that's the problem. And then you have to face the fine. So blockchain in a very short chain sequence, I'm talking about a block, is basically this aggregation comes and the VP or whosoever says, this I don't like this 2 billion. Let's make it 2.5. He goes in Excel and types 2.5, enter, submit. And nobody knows why this 2.5 is there because some VP did it. Now, if this was a blockchain, I could have recorded the transaction. What the chain would be 7, 6, or even 5 entries, but that would be immutable. Immutability is the key here, and not a distributed ledger. Research existed for a long time, not a big deal. But then formalizing this process is very interesting. And that's my take on it, is that yes, it could be a very short chain of a block. But that's interesting. We can, and also the second part is crowdsourcing. If I think about it, more than 51% bit, what do you call those? Not the miners, the other guys. What's the name for them? Well, anyway, who vouches that this transaction is good? Have to say yes. And still Trump won in America, right? So that means that majority doesn't always is correct. I would like to say that, no, I don't want 51%. I want 99% vouching for it that this transaction is correct. Not 51, because otherwise Trump wouldn't have won, right? That's the whole point. So I'm making it that yes, we have to make it stronger. That's my take on it. 51 is not enough. I could hack 51.
That's very true. But just to add on that, so if you want 99% of all the nodes in the blockchain network to say yes before committing any transactions, we have to look at from a compute power and the time perspective too.
Exactly. So you're going back to centralized mechanism again. So one more thing is that government wants power in the middle. How do they tax your money? If I pay something to her and don't pay service tax or sales tax on it, how does the government make money out of it? So are you going to report every transaction to government? Oh, it might happen immediately, but it's get reported. Is it the idea? No, the idea is that don't even report it to government. So I think it's going to face a lot of challenges from the regulators. They want to know everything. Who's paying money to her? Why am I paying 100 rupees to him? That's my take on it. So let's see how it evolves over next 5 years. And yes, we need to. This is the new Deepika in town, so our movie has to have it.
Thanks, Makaran. Harsh, you want to say something?
Only one point I want to mention that what blockchain brings in, the uniqueness is, yes, it's immutability. The thing that it brings in is also the point that in prior systems, people were connecting systems, information systems were connected to from one point to another point. None of them were trusting one unique or abstracted value. That's what blockchain brings in, and that's the beauty of it.
So my perspective on your question is that you said that 99% of all the nodes.
I'm just telling you an example.
No, I agree.
I want to be sure about it.
So that may be true in a public blockchain, but when you move with a different, like, so we're talking about proof of stake or proof of work, a different basically consensus framework. So if you are moving to, say, for example, a private blockchain where you have 3-4 major banks being party to the forum, you don't really doubt on every node, right? You know the other party in the forum. You can control the access rights, you can control the transactions and the actions they can do in the system. So we can move to more like proof of basically work or proof of stake.
So it's a trust issue. Do I trust this machine to say yes to my transaction? And if I trust it, I'm going to even one is good enough then for me. Okay, crowdsourcing is more than 50% have to say yes, then it's okay. In a trusted environment, in a private blockchain, this crowdsourcing doesn't going to matter. It's going to a few trusted computers that say yes to it, and everybody says okay. 4 banks go in a Bitcoin, so not a Bitcoin, blockchain kind of an arrangement. They designate maybe 100 servers who are known to be good and known to have been not hacked, latest, and they're going to say yes to it. Or maybe they'll say good 51% in these good guys, not this public 100,000 guys.
Yeah,
it's going to be again centralized mechanism. Think of it this way: it's not going to be public.
That's an interesting view. I mean, so let me move to Nitin. So Nitin had a very good perspective on a maturity model on blockchain-based applications. I would request you to sort of give us that flavor.
So, as basically a consulting organization, one of the challenges we face when we are getting into customer situations is the identification of use cases, obviously. I mean, where is blockchain relevant? The second thing is really the maturity of the technology, right? And, everyone is saying that, yeah, it is from a security perspective, it is a lot better than what we have currently, or from a scalability perspective, there are certain questions about it. But is there a way to basically, work customers through what are the different sort of, what stage of maturity is this technology at? And there have been certain studies that have been done, which are very akin to the capability maturity model. Most of you must be knowing CMM, right? It's got those 5 stages through which everything goes. And that's been applied to blockchain. So I would really recommend that you guys, if you go on a net, you'll find out that there is a blockchain maturity model that's in place, which talks about, from a networks perspective, from an infrastructure perspective, even from basically, really all the stakeholders are involved, scalability, management, etc., the standardization, how is this technology placed? And today, what they're saying is that as recent as about 5 months back, the technology is quite mature when it comes to privacy and security, but when it comes to scalability, when it comes to storage, when it comes to really standardization, is a long way to go. Okay, and then when you have that in place, you actually can walk customers through the journey of implementing blockchain. So to your point on private blockchains, that seems to be the way that customers are most comfortable taking it. And when you say private, then of course something, all the entities are essentially known. Okay, so this really works across against the philosophy of what really a blockchain should be, but that's what most customers seem to be comfortable with. Okay, and that the proof of stake is again the same thing, right? I mean, it goes against the philosophy of what blockchain is supposed to be, but that's the start, and then we will pretty much, so like moving from a private to a hybrid to a public cloud, that's the journey that we are in with blockchain right now.
Thank you. So one sort of use case I want to put up in front of you guys, right? So blockchain, we are talking about ideally removing the middleman, right? So we are saying that all these central counterparties, right, can just go home, right? blockchain-based, software-based consensus framework can manage the default funds, can do the netting, can do all the payments, and can manage all this centralized clearing in a more near real-time manner, right? But what we see today, right, DTCC. So instead DTCC going out of business, DTCC may be smart enough, or even Swift, or maybe CCIL, which is Clearing Corporation of India Limited, they are basically coming up with their own blockchain implementation, right? So it's like, I don't know what's the best analogy, but it's like you want somebody to go out of your house. It's like he got a new role in the house, right? So what's your viewpoint on that? I mean, how do you see that play gonna happen?
Okay, here I'd like to point out to the area that Mehul pointed out. It's about that blockchain will become like a utility. It's a common utility across industry. So in this situation, the utilities cost has to be borne by someone. So now that someone will have to be a party, or it can be shared. So now how it is shared in a consortia, that agreement would differ, or that agreement definition would be there. Right now, all the licenses, this again goes to the licensing part of this blockchain. All the licenses of the software that we have today are licensed to one organization. They're not consortia licenses, or not a license to a group of companies, parties participating to that particular use case. So that is something that is I see as a legal evolution coming in time to come. Yes, there are some debates that are already happening on these lines, but this is the traction that I see coming in time to come.
Interesting.
Yeah, I agree with you. This is a tool. It's like a screwdriver. You can important uses to drive the screws. I can also kill somebody with it, and more interesting uses can be done with it. So think of it like a Swiss Army knife that has been developed. Do you have to use it? Well, mostly I can use it here, here, here. Oh, but I cannot use it for cooking. Well, then now you don't use it for cooking. That's the whole point.
Regarding DTCC, I can add something.
Yeah.
So, we're talking about this entire ecosystem effect. We're talking about replacing a system that has been working for so many years. And we're talking about entry points into the system. You cannot start with a complete overhaul of the system. You cannot start with saying that I'm going to disintermediate all these intermediaries, and the final state, nirvana state could be you have only the issuers and the investors that remain, and all these intermediaries are disintermediated. But to get to that, you need to kind of start with the small steps. And I think this DTCC and all, it's kind of a technology upgrade where you start with those small steps, and then who knows how it will evolve. They themselves get converted into utilities. You will start seeing the license cost coming down, to his point. So
Yeah.
it's an evolutionary cycle. It will take a decade.
Yeah, absolutely.
Again, just continuing on the disintermediation thing, right? So we are working with a remittance company, and one of the things that they think blockchain will help them disintermediate is the agent network. Okay, but the problem there is that there is a huge human element involved behind that. What do you do with all these agents, right? And then there are different issues that come around that piece as well. So disintermediation is not as simple as it seems.
Yeah.
The other thing that's happening is that again, because of a philosophy issue, right? You're looking at blockchain, and then you're saying in the same breath that oh, it needs to be centralized and someone has to really control it. Okay, so that again kind of goes against the grain of disintermediation to some extent, because some entity tries to assume a position.
Yeah.
If you take let's take a private blockchain where banks are there, and they are the nodes in the blockchain. Okay, but then if you see what we call as rails, right, the network companies, they are coming into play and becoming the tokenization guys. Okay, so they are actually assuming a very predominant role in the way the blockchain works. Whereas, is there a need for them to be there? No, but they have assumed that position. You look at someone like Visa, they're trying to do exactly that. So it's going to be a bit difficult to really say that blockchain is going to result in disintermediation, at least not in the immediate future, as far as I can see.
That's a very good perspective. Moving to Harsh and a little bit on the tech front, right? So you are doing this KYC ledger product, right? And you have spoken a little bit about, you are putting up a lot more business rules, AML driven things, etc., so on and so forth. So my first question is, are you using smart contracts?
Yes, we are using smart.
Okay, and if yes, because today, if you use any blockchain framework, right, whether it's Ethereum or anything which is forked out of it, right, the smart contract gives very limited functionality in terms of computing. I'm talking about like heavy compute, right? I mean, scenario based or more complex event processing or more activity monitoring sort of. So are you evolving the technology? Are you building something of your own? What's your take on that?
Okay, firstly, smart contract is one component of the entire system. It's like there are multiple ends to the system, and the system is not just limited to KYC as a function. It can span to multiple use cases also. It's like a plug and play system that you can build. So you can plug multiple elements of multiple use cases onto the same system. So that's what we are building.
Interesting. Okay, so let's come back to our most interesting topic, Bitcoin, right? So what do you guys think Bitcoin is going? I mean, we see, right, Brexit happened, right? I mean, GBP went down, Bitcoin is up. Trump won election, all the emerging market currency pairs went down, Bitcoin went up, I think by around 8 to 9%. It's around $750 around today, right? And I think when Bitcoin started, people are saying that it's just a fad, it's just by amateurs. There has been a lot of frauds in Bitcoin, Mt. Gox, silkroad.com, zillion incidences, right? So, but still Bitcoin is going strong and it's growing. So any perspective you guys want to give in terms of where Bitcoin is going? What's your take? Any projection?
You are the
Let's say it's more like an autonomous system. So
the whole
like
thing. Sorry, go ahead.
it would work parallelly, because there are two things that I pointed out sometime back. It's like you have the network sovereignty and the national sovereignty. So the fiat will become the national sovereignty component, and the Bitcoin will become the network sovereignty component of the system. So that would go on, but the thing is, recognition would be a question, because if you look at ICANN, I was present there, and in ICANN also the same question prevails, that which legality will prevail on internet. That's still in a debate. So hence the debate on legality of Bitcoin will also prevail, because it is cascading from internet.
It is interesting because regulators want to make money. They want to pick up your sales tax and income tax. How are they going to pick up sales tax on Bitcoin and income tax on Bitcoin? Like once you solve that mining thing, you get like 25 Bitcoins or 1 Bitcoin or whatever nowadays, whatever. So you basically, Bitcoin is created out of thin air, given to you like a, there you go, magic 1 Bitcoin for you because you solved one puzzle. And then you start trading it. And then and actually end up buying a tractor with it or something, right? You can actually nowadays buy physical things with Bitcoin.
Yeah.
And send him Bitcoins and give me, I don't know what, coffee or something. So
I think Starbucks is accepting Bitcoin.
Exactly.
Yeah.
So you can buy coffee with it now. Now, who taxes Starbucks on Bitcoin income? That's when good. Okay, Starbucks may be different because they might say, oh, the $2 worth of Bitcoin I sold, and they might actually pay tax. But that's going to be a big thing. And it's I was in one of the meetings a couple of months back, and they were like a couple of Fed guys there. And they said, we need to somehow tax it. I said, oh, please go ahead and tax it. I don't know how I'm going to do that because they don't even come to you to be transacted. So that's one thing that is going to be a challenge. Unless it's a world government or something, it's not going to work, maybe.
That's
Utopian.
interesting. Yeah.
So I have, the way I look at it is from a end consumer perspective, which is people like you and me, okay? What has technology been doing over the last so many years? Essentially, it is, in a sense, trying to make life easier for us and disrupting whatever is causing heartburn, okay? So I always wonder that why do I have to deal with different currencies? Okay, what's the need for a currency at all? Yeah, and if things are going the way they are going because of technology, okay, my view is that a day will come when, forget Bitcoin, and Bitcoin is just another thing, right? But essentially, you don't need anything called currency. Okay, it'll happen in a completely different way, something that will be very seamless, frictionless, okay, which we don't really have to manage and be worried about, okay, and which nobody is governing in some sense, okay. I think that'll come, and an analogy is Facebook, right? I mean, if you look at it, which is the biggest, in quotes, country in the world today? Yeah, it's something like that is going to happen on this front, is what I think.
That's an interesting stake. So with this, I will take a pause, and I think we'll open up for the audience Q&A.
Most probably because forget the black money market in India, 30% black or just take the case of something like Denmark, for example. There apparently is 0% black money. And then you take out the cash, and where do you pay the tax there? I give it to you. You're supposed to report on your income statement.
I mean, just a declaration. I've been trading Bitcoin for 5 years, and I've been declaring my capital gain and capital loss and paying my taxes. So I mean, I don't see
To
any.
whom do you declare? That's my question.
The income tax department, it's
Cool.
capital
There's
gain
a
and
good guy
capital loss.
here. There's a good guy here. See, and they actually do something with it, or do they take like the today's market value and things like that?
It's typically how you trade gold, right? You have a certain price, you buy gold at a certain price. Whether you make a profit or a loss, that's capital gain or capital loss, and it's quite simple.
So there you go. So I didn't know about that one. So
If I were to buy a Bitcoin, let's say one Bitcoin for $100, and by the end of the year it becomes 200, then I made a capital gain of $100, plain and simple. Now, of course, you're making an account declaration that that's a value. Now, if you could choose to pay advance tax if you wanted to, or if you can just hold it as a position, so that's an investment of $100, and whenever you do sell it and you realize you claim your, I mean, you pay your capital gain taxes accordingly.
yeah, I think because
I've been filing returns, sir.
no, guys.
Mentioning it as Bitcoin, not something else.
No. My question is, did you buy bitcoins or did you get them out of thin air? Is my question. If you bought the Bitcoin using $100 from your credit card, then of course you bought a commodity in a way. But if they just gave it to you because you mined something for them like a free Bitcoin, anyway, take it offline. It's a hairy issue.
Oh, okay. One question from my side. Mainly it's for Harsh. And again, it is with respect to Bitcoin itself. Is there any mantra to appreciation and depreciation of the value for Bitcoin? Are we seeing something with respect to there's a demand or supply gap? Because how a particular investment appreciates or depreciates, it's always dependent on like gold appreciating, depreciation basis the demand and supply for a product. We have something like that because the formula for Bitcoin is like there are only limited Bitcoins which can be produced, and over a period of time, as we become closer to that number, the demand is always going to appreciate. So for a consumer like me, does it make sense to put say 56,000 rupees for one Bitcoin, buy it from ZepPay, keep it, and after 10 and 15 years, it's going to be like boom. So start investing. That's what.
Firstly, a disclaimer, I'm not a Bitcoiner. I'm mostly into blockchains.
Okay.
You want to go? You want one sentence on blockchain, huh? Immutable transaction.
I have a blockchain question. Can you implement a centralized business model with a distributed ledger or blockchain?
It will have to be trusted though. Yes, distributed ledger is possible. It's like a domain controller validating you.
Implement a centralized business model
Okay.
using blockchain.
Theoretically, yes, but you'll have to replicate the data across nodes and they'll have to be trusted.
All the parties, if all the parties are in one same, all the servers are within one same organization.
Yeah.
Exactly.
Could you give an example of like what do you mean by
Most business models around the world, the ones which are meaningful and large, are centralized. Take anything. To take something simpler, frankly, personally, I don't know what DTCC means, but let's take Google. Right? Google's business model is centralized. If they could not analyze your data, they would not be in the business of search and everything else which revolves around it. Okay, I think you raised a good point around governments and taxation. It's centralized. So when I look at business models, yes, of course, there are some, which are distributed business models. But to me, every meaningful business model is a centralized business model. So how can you take a distributed ledger to implement a centralized business model? I'm not saying it can't be done. I'm just curious if you can figure that out.
Every meaningful business model is a centralized business model. So I'll give you another example. Isn't when you're basically entering into a trade, say in the capital market, right? If you're entering into the credit market, where you have your issuer and you have the investor, right? You're trying to raise, you are a corporate, you're trying to raise a huge amount of working capital, right? You're trying to raise, say, a commercial paper. Why is that a centralized business model? Why would you term that as a centralized business model? We're not. So there is an interorg. So any. But if there is no value add, so this is like about a problem. It's like about a hammer looking.
Just saying that there are centralized business models. You're the blockchain expert.
So one example that comes to my mind, this is about, we're talking about whether there is an ecosystem, and ecosystem being one of the main kind of a blockers in terms of really kind of putting together the blockchain system in the organization. So there are use cases now that are emerging where within a same organization, you could have multiple legal entities that are trading with each other. Now, if you call this a centralized business model, this kind of a business model, yes, there is value in using blockchain. Business model, you can avoid your reconciliation costs, you can avoid other kind of operational costs in this kind of a business model by using blockchain. If that satisfies, what you're looking for.
I'd like to point out towards the token market, or what do you say, crowdfunding over bitcoins, or crowdfunding over cryptocurrencies. That's one particular model that I see that can be centralized, but it will take its own turn in way where how the credit unions were formed. So it will have mixing three different sets of models. One is your credit union model, other one is your crowdfunding, and mixing that to Bitcoin-based cryptocurrencies or crowdfunding on Bitcoin. That would make a model out of that. That's a way I think.
That part, I think, can be decentralized and become to an ecosystem where the value proposition is so
Yes.
Okay, maybe we'll just have one last question. Yeah.
You're trying to implement towards the trade finance scenario. So let's say you're decentralizing it. So now the Barclays will talk to another Barclays, okay? And let's say you're replacing 700 or 707, okay, with the new technology. Then how you're going to use towards the UCP guidelines? Because the guidelines won't say you can do without papers, because there are so many rules, especially in the trade finance, and it has to go through it. So the process will remain as is, isn't it?
So the trade finance use case specifically, that is not inter, that is not intra. That is inter. In terms of the regulations now. So I'm not from the trade finance side of it, so I won't be able to answer your specific question around that 700, and I don't understand those. But right now, the implementation that is happening, I can tell you that's happening in the UK jurisdiction. So I don't know whether it is inter-jurisdiction that they are looking at right now, or whether it is just intra at the moment. Yeah.
Okay, thank you guys. I think we are sort of there at the time, so we'll take questions later. We have sessions later. We can have offline conversation. Again, thanks everybody. Thanks all the panelists for your views and time. It was a fantastic conversation. Thank you.
Thanks, Bhushan, and thanks to the panel. So we quickly have one last session. from my dear friend and the co-founder and CEO of Let's Talk Payments, Aditya Khurjekar, who is based out of Charlotte, North Carolina. He's traveling, and this is the time when we always have the event when he's here. So Aditya, please.
Thank you, and thank you to all of you. And so my spot here was very strategically chosen, right? Because he said, "Look, I have to keep you last because if you start talking and don't stop, then nobody else will get a chance to talk." So I have some good news and some bad news. Okay, I have some good news and bad news. Um, here's the good news. I have no point of view on blockchain or Bitcoin or RegTech or any of that. I have no point of view because I want to go back from here alive. So I have nothing to say about all of the wonderful, content part of this session. Bad news where there isn't any bad news. That's the news. Because the way I see it is that sessions like this are tremendously powerful, not just for the people here, not just for the fintech ecosystem in Mumbai or in India, but this is tremendously powerful for the fintech industry overall in the world. One of the things that Amit and I have done over the last 3-4 years is really, even though we are small, right? We started in August of 2013. For those of you who don't know us, as just the two of us. Today we are 25 people, and who's counting? We are growing. And the thing about, even when we were 2 people, we were global by design. And the reason that's important is that when we look at fintech insights and fintech content and fintech research and using our media property, which is let's talk payments.com, using our innovation portal, which is Medici, we have always taken a global view. And global, it means different things to different people. For us, it simply means that you have to be present virtually or physically in every fintech innovation ecosystem in the world and share learnings across all the ecosystems, right? I mean, look at what we have here. Nisha from Charlotte, she's sharing with you what she's seeing in RegTech with a group in Mumbai, right? We have here Arpit and Harsh, startups, entrepreneurs right here in Mumbai, telling her that we don't have the problems that you do. We are far ahead of you, right? We have Varun here. Basically, he's not even a regulator, but he pretends to be one. I don't know, where is he? Okay, so Varun pretending to be a regulator when he's not one, just because he hangs out with them. Look at the cross-pollination. Where is Makarand? I enjoyed his comments. He's outside there. He's telling his gyan to other people. But look at Makarand, right? He's telling you that Excel was the first blockchain implementation. Look at the audacity. What I'm saying here is that these conversations are what makes our industry so beautiful. Goldman Sachs says this is what, some $4.7 trillion opportunity globally. Even if it is half of that, even if it is 1/10 of that, there is so much work to do. Okay, we have been at this for how many years? I mean, much shorter than Mehul, right? We have been at this, so I mean, it's such an honor, such a privilege here for me to even stand here, right? With such a great session, people putting their passion and their thoughtfulness and just the deep knowledge of everything. Even the questions. I mean, to ask the questions that I heard today, you have to know the subject very, very well, right? I just wanted to celebrate this, acknowledge this. Thank you all. I want to especially thank the moderators. I want to thank Bhushan and Anshu for being able to deal with the crazy panels that you had here, not allowing you to do your job properly. So thank you for doing that. Mehul, of course, Mehul is like a brother to me. Thank you for being here. Appreciate everything that you do. For those of you who did not know Mehul before this, hopefully you got a sense of how he thinks and the long-term view that he takes. I have been fortunate to have known him for almost 8-9 years now, and well, I guess Amit wants me to do some slide stuff like a consultant. I'm not a consultant, but I'm going to try. The heading is gone. But anyways, let me just finish my little quick vote of thanks, and then I'm not going to stay in between you and dinner. So thank you for being a great audience. Thank you to all the panelists, even those I did not name. Thank you especially to Opus. Where is Nitin? Nitin, thank you, Opus, for feeding us tonight and for making sure that we can enjoy this evening and we can go home with a good state of mind. And thank you to our friends at Barclays. Definitely, we could not have done this without all the wonderful hospitality that you extend to us every time. So appreciate that a lot. And thank you also to, I'm sure I'm forgetting somebody. Thank you to Makaran. Well, he's outside, so I'll talk to him later. And if I miss somebody, I apologize. Let me end on a very quick note, because this 2008 came up a few times today. Okay, who remembers 2008? It's okay if you don't, because that just means you're young, so it's okay. If you do, then you're old. So at your own risk, raise your hand or not. But 2008 is when I believe FinTech 1.0 started, because it was the crisis and the chaos that the early creative disruptors were forced to do something and call themselves disruptors, right? And so that is what I call FinTech 1.0, where it was a necessity. Okay, it's not that the banks did not know what to do. The banks found themselves in a trap, and somebody else had to pick up the mantle of innovation. So the technology young companies were almost forced to innovate because of the circumstances of 2008. FinTech 2.0, if you kind of fast forward from there a little bit, right? The biggest learning of FinTech 2.0 in my mind is that elephants can dance too. No more proof of that than Mehul here in the room, right? CSAM was the wallet provider for the only joint, or the only North American joint venture between the fiercest mobile operator competitors in the world, right? Who was involved? Look at Apple Pay. And I talked about this the last time. Who was involved? Pretty much every big brand you can think of in the financial services world, in the retail world, in the technology world, dancing together. That is a tremendous testament to how FinTech is maturing as an industry. Not only that, these elephants, the big banks and the big financial institutions, are also now mature enough to say that, you know what, I'm going to allow those little ants and rabbits who are like, in my road to work with me. I'm not going to trample them. Banks are working with startups in open mind, open innovation. We are seeing it happen. The fact that we are here is testament to that. FinTech 2.0. And I think where we are going is really an extension of FinTech 2.0, where we are saying collaboration is truly where we are going, and what will make this industry a multi-trillion-dollar industry, right? And I think this is just the beginning. If you could switch to that last page with the beautiful bulbs, just very quickly. I don't want to take too much time because there is food. So here's what excites me about where we are going in FinTech 3.0. Look at the new stakeholders that are coming into FinTech. Okay, we have financial institutions, startups, investors, big tech companies, insurance companies, regulators, foundations, right? Bill and Melinda Gates Foundation, Rockefeller Foundation, Ford Foundation. There are a number of new stakeholders. We have new models of collaboration. How many times did you hear the word today? Consortium, sandbox, powered by this, APIs. This language wasn't even spoken 2 years ago. Can you imagine this? Just 2 months ago, we were not speaking this language. See how fast the industry is going. We are talking about enablers, industry agnostic, talking about about open platforms and design thinking and product thinking, data, AI, ML, bots. I mean, this is an industry which was able to produce only 5 payment innovations in 5,000 years. How many innovations do we have in 2 years? We all should feel proud, right? This is a fascinating place to be. I would not be in any other place, right? We are innovating at scale. Important point. Nobody cares about a little innovation in a little app that only works in one town. What does it make? It makes no difference. We are here able to, because of all of these things, innovate at scale that make a true impact. I mean, going cashless by fiat, sorry, cash replacement by fiat, otherwise Mehul will not let me go home. Going cash replacement by fiat in a country of billion and plus people, amazing. Never been done before, right? I had the privilege of knowing Nandan Nilekani in 2009 when he offered me a job to come work for him. He said, I won't pay you anything, but you'll have fun. I said, I'm sorry, I have kids to feed. I can't do it. Biggest regret in my life. Look at what we have done. We have Aadhaar card, right? 100 million real-time authentications every day. There isn't a parallel in the entire world. This is innovation at scale. And I think the advantage of you being here in India, in Mumbai, tremendous, right? The world is watching, the world is listening, the world is learning. And we are fortunate, Amit and I, to be able to take these learnings from this ecosystem transport it to different parts of the world, bring learnings from that part of the world here, and let's build this industry, this fintech industry together. So again, thank you all very much, and hope you enjoyed. Thank you.
Thank you everyone for coming. We have dinner for you guys. Networking will obviously take place. Feel free to ask those questions, people who we had to cut off because we were short on time. I'm sure most of the panelists are still around, so feel free to catch hold of them and ask those questions. Happy dinner.